pressure this morning, but up more than 15% for the month. One of the group's biggest holdings is Qualcomm, reporting an earnings beat last night, but the company also saying it sees a 30% drop in iPhone shipments compared to previous expectations for the next quarter. The stock had a turnaround. It was up last night after hours, down almost 2%. An exclusive interview coming your way with Qualcomm CEO Steve Mollenkopf in the next hour, and of course, Apple earnings after the bell. We're going to take a quick commercial break here. Stay with us on Squawk on the Street. The Dow is down about 264 points. The NASDAQ was positive, has lost a little bit of steam here, down about a third of 1%. We'll be right back.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
Are greater when we come together. But possibilities aren't easy to imagine, and togetherness is more precious than ever. So, to the advisors and the institutions and the people we all serve, we are here to help you find those possibilities together. Visit Invesco.com/what's possible.
Since 1926, Nationwide has been on your side.
We've been there in person during trying times.
Today, being on your side means staying home.
Nationwide Office of Customer Advocacy.
Nationwide.
But we can still support you and the heroes who are with you.
We're giving refunds on auto insurance premiums.
Assisting customers with financial hardships.
And our foundation is contributing millions of dollars to charities helping with COVID-19 relief.
Keeping our promise to be on your side.
Does learning a language feel like this?
No habla español?
Hablo.
It's hablo?
Yes.
It's hablo.
When you learn a language, you want to actually use it. Babbel is designed with that goal in mind.
Since my husband is from Guatemala, I'll apply what I've learned in the Babbel app to our real-life situations.
The app is so easy to use and it's so practical. It helps you learn things that you will actually need.
Hoy es miércoles. Y el clima está muy bueno afuera.
Language for life. Go to Babbel.com and try for free.
It started in 1898, helping clients and communities invest in hospitals and schools, roads and bridges, farmland and forests, small and large businesses, and sustainable cities around the globe. It continues today, more than 120 years later, investing to make an enduring impact on our world.
There's TV, and then there's X1, featuring the Emmy Award-winning voice remote. Access to your favorite apps, including Netflix, Prime Video, YouTube, and Hulu, all without changing passwords and inputs. The most 4K content and movies and shows on any screen. The best entertainment experience, all in one place.
Dow down 250 here, off the session low of minus 378. When we come back, former ECB President Jean-Claude Trichet will join Rick as we put this final trading session of April to bed. Back in a minute.
With the NHL season temporarily on ice, now is a good time to catch up on past games. With Game Replay on TuneIn, you can hear every matchup of the 2019-2020 season so far. And for a limited time, it's free for hockey fans everywhere. Search Classic Game Replays to start listening.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
Wi-Fi connection spotty? Make sure you're never without something to listen to by offlining your podcasts on TuneIn. Just find your favorite podcast and tap the three dots to download the episodes you want to hear. When you're off the grid, you'll find all your offline audio under your favorites.
Keep up with everything happening in the wild world of pro wrestling with a TuneIn podcast. For expert analysis straight from the WWE to Steve Austin's no-holds-barred conversations with wrestling's biggest personalities, search sports and scroll down to the world of wrestling to listen.
Brian Windhorst and the Hoop Collective Podcast.
What about Giannis Antetokounmpo?
he is going to be eligible to sign a Supermax extension, which we were projecting to be worth $240 million this summer. Well, if the salary cap drops, and even if he's wonderfully happy in Milwaukee, it may make no sense for him to sign when he can just wait a year and wait for the revenues to recover and then lock in.
Subscribe to Brian Windhorst and the Hoop Collective.
Search the Hoop Collective to listen.
A social distancing tip.
Keeping your distance from others is important in slowing the spread of coronavirus. So here are some fun things to do alone. Read a book, take a walk, unpack your suitcase from that trip you took last September, paint a self-portrait, catch up on a TV series.
Welcome back, everybody. I'm Sue Herrera. Here's what's happening at this hour. April is likely to be the worst month for auto sales in at least 30 years because of the pandemic. The forecasters at Edmunds predict April sales fell 53% from year-ago levels. On the positive side, Edmunds also says April is likely to mark the bottom for auto sales. Macy's plans on opening 68 stores on Monday. The reopenings are in states that have loosened their restrictions. Another 50 locations are scheduled to reopen on May 11th, and the CEO expects to have all stores back open in 6 weeks. However, in Massachusetts, a Walmart there has been closed after 23 workers there tested positive for the coronavirus. Local officials say all 400 employees must be tested before that store can reopen. As always, for more on our coronavirus coverage, you can head to CNBC.com. Sarah, back to you.
All right, Sue Herrera. Sue, thank you. CEO of Kellogg is just moments away after the food company posts a very strong quarter of sales as Americans stock up on packaged goods at their grocery stores. We'll be right back.
Behind the highlight reels, championship rings, and colossal paychecks, there are sports stories that fuel, deepen, and even challenge our love for the game. For true tales of underdogs, anti-heroes, and game-changing innovators, search sports documentaries on the TuneIn app.
If you've used TuneIn much, you probably already know how to favorite your top stations and podcasts for quick access. But did you know you can organize your favorites too? Under your favorites page on the TuneIn app, hold and drag the stations to rearrange the order to your liking. It's that easy. In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
With the NHL season temporarily on ice, now is a good time to catch up on past games. With Game Replay on TuneIn, you can hear every matchup of the 2019-2020 season so far. And for a limited time, it's free for hockey fans everywhere. Search classic Game Replays to start listening.
Hey, it's Jacoby here from Jalen Jacoby. And after you watch The Last Dance on ESPN, which you're obviously going to do just like the rest of us stuck in our homes in quarantine, you can join Jalen Rose and I for Jalen Jacoby, The After Show. And we will be joined by the director of the documentary series.
How the U.S. handles the reopening of the economy could tell us whether the lows have been put in for the market, says top strategist Jim Bianco. Find out more on tradingnation.cnbc.com. More Squawk on the Street coming up.
If stiff pants are a problem, fix it with Duluth Flex Pants. Only at Duluth Trading.
When the world gets complicated, a lot goes through your mind. With Fidelity Wealth Management, your dedicated advisor can give you straightforward advice and tailored recommendations. That's the clarity you get with Fidelity Wealth Management.
Welcome back to Squawk on the Street. A lot of talk this morning. Rick Santelli had mentioned it on his report in the last hour about Boeing and a potential bond deal there. I do have some color from people who are obviously in the market involved in putting together what might be one of the largest financings we have seen since this crisis began. Let me give you some color here. We spoke to Dave Calhoun yesterday, of course, the company's CEO. He was non-committal in terms of where the company was focused for raising funds, raising liquidity, whether it would consider some government programs that are available or go solely in the bond market. If they should choose solely in the bond market, it appears they are going to be well met. I am told by people familiar with the situation that demand for the paper that would come at the 5-year, 7-year, 10-year, 20-year, 30-year, and 40-year maturities could add up to as much as $75 billion. Now, Boeing is not going to go to the market for $75 billion. I'm told that they were looking for what could have been up to as much as $20 billion in capital that they would be raising in the bond market. But perhaps given the significant demand, they may in fact even increase that. If they're looking for making sure liquidity is off the table as a question, perhaps Boeing and Mr. Calhoun will choose to say, all right, we'll come for $25 billion. It does appear, though, that they will be able to get really whatever they would want at this point at those maturity levels. The pricing that I'm hearing right now is somewhere between Treasuries plus 500 basis points, or let's just call it somewhere between 4.75% and 5% yield on the 10-year maturity, on the benchmark maturity for the company. And again, they have access to durations across the board, it would appear at this point. So, Sarah and Carl, right now it would appear Boeing in a very strong position in terms of it looking at the market and how much it wants to raise, and doing so, frankly, at a price that is quite reasonable, one would say. Let's call it 5% at 10-year money, maybe a bit less. And again, looking at 5, 7, 10, 20, 40, 30-year maturities across the board here with enormous potential demand, perhaps precluding their possibility of them having to even go to the government. Yeah, what, Sarah?
Yeah, so it's Boeing today. It was Delta a few days ago. It was Carnival Cruises a few weeks ago. These are all companies that were caught right in the middle of the storm of the economic fallout from the pandemic, and all companies that were mentioned as being, recipients or potential recipients, in Delta's case, it went through, of government relief. All of them speak to the fact that the credit market is so much healthier than it was in that mid-March period where the market was selling off and we saw some real blockages in terms of bond market. All of these CEOs need to write thank you notes to Jay Powell, the chairman of the Federal Reserve, who hasn't even stepped into the corporate bond market yet, but through signaling that they were going to expand their program to try to keep borrowers borrowing and lenders lending by entering the corporate bond market, are able to do that. And they're able to raise some much needed cash and get access to liquidity during this tough time. I think it really speaks to what the Federal Reserve has been doing to try to get the system moving.
No doubt. Boeing raised I think it was $6 billion. Here we're talking about a far larger amount of money for, of course, a far larger company, Sarah, as well. At least $20 billion seemed to be what they were looking for, up to 20. They could go higher than that. If you're Dave Calhoun, it's an interesting decision here in terms of, do you want to just take it off the table in terms of anybody questioning your liquidity? Take $25 billion, perhaps, even, if you could get it at these prices that they're talking about, and not have to worry about potentially coming back at some point to the marketplace for additional funds. Yesterday he was talking about not being able to get back to previous levels for perhaps as long as 3 years, maybe even longer than that. But to your point, Sarah, the bond market is wide open. You obviously have been talking about where the 10-year currently is in terms of its yield continuing to come down near the lows. But still, being able to borrow at all those maturities, so let's call it around 500 basis points on average at the 10-year level, would be seen as a victory. And again, I'm told as high as $75 billion in potential demand right now, at least, for whatever they decide. And Carl, they're going to have to make their decision today. So we should know more about this as the day goes on.
Yeah. I did see S&P formally rated the unsecured BBB-, which we knew yesterday. But as for the equity, David, wow, $89 on March 18th. now 143, as some of those liquidity concerns are pushed to the side for a bit. Meantime, a lot of discussion this week about the food supply in this country, and it's true that processing plants hold all the cards, but if ranchers and farmers go bankrupt, then we really will have less meat. Our Jane Wells has more on that today. Hi, Jane.
Hey, Carl, I'm at Underwood Family Farms, meat sassafras. You know, with all the talk about the meat packers and their problems, they are still enjoying huge margins. There's been a lot of consolidation. Ranchers complain that they control the market. And even now with plant closures, as their labor costs go up, they're still getting margins. We're hearing of $1,000 a head per head this week. Where there are no margins is the last step before the packing plants. The feedlots, like one owned by Lee Richmond in Nebraska, some of these feedlots cannot sell any of their animals. These are where animals go for the last 6 months of their lives to be fed and fattened. The national slaughter, we're told, is going to be down 36% this week from a year ago because of plant closures to only 450,000 cattle, and Richmond is losing $300 to $400 per head.
The issue that we run into is that these cattle continue to put on pounds every day, and if we can't get them slaughtered in a timely fashion, the cattle get too big on us.
And when cattle get too big, it costs more to feed them, it costs more to slaughter them, and you, the consumer, end up with this gigantic Fred Flintstone, brontosaurus steak. Live cattle futures are way down, unprofitable right now. And guys, basically what they're saying is that the aid to the feedlots is capped at a point now that many of them may go bankrupt. And so we will eventually perhaps have a meat shortage, though right now we've got a glut. Back to you.
Jane Wells. Jane, thank you. Coming up, we're going to continue the conversation about food. CEO of Kellogg, fresh off those earnings results, will be with us. We'll be right back.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
Keep up with everything happening in the wild world of pro wrestling with a TuneIn podcast. For expert analysis straight from the WWE to Steve Austin's no-holds-barred conversations with wrestling's biggest personalities, search sports and scroll down to the world of wrestling to listen. With the NHL season temporarily on ice, now is a good time to catch up on past games. With Game Replay on TuneIn, you can hear every matchup of the 2019-2020 season so far. And for a limited time, it's free for hockey fans everywhere. Search classic Game Replays to start listening.
If you've used TuneIn much, you probably already know how to favorite your top stations and podcasts for quick access. But did you know you can organize your favorites too? Under your favorites page on the TuneIn app, hold and drag the stations to rearrange the order to your liking. It's that easy.
America, your children have an amazing superpower. That's right. They can help save lives by simply washing their hands. Just 20 seconds of thorough hand washing after they've coughed or sneezed or been outside can help fight against the dastardly spread of germs. Armed with only soap and water and hands, your superhero can protect you, your family, and everyone out there in America land. Amazing! Find out more at coronavirus.gov. A message from the CDC and the Ad Council.
You love listening to ESPN Radio live on TuneIn, but did you know you can also listen to favorite ESPN shows on demand? Get the latest takes from Stephen A. Smith,
dynamic duos all over the place,
Dan LeBatard, and Garlic and Wingo when it fits your schedule, and listen to episodes of Pardon the Interruption.
Pardon the interruption, but I'm Israel Gutierrez, and I love hosting the show with my humble...
Around the Horn and Highly Questionable as podcasts anytime you want. Search ESPN to see all the podcasts on TuneIn.
Behind the highlight reels, championship rings, and colossal paychecks, there are sports stories that fuel, deepen, and even challenge our love for the game. For true tales of underdogs, anti-heroes, and game-changing innovators, explore a sports documentary on TuneIn.
For car insurance.
Thank you. With the pandemic changing the American consumers' eating habits, packaged food stocks like Kellogg have been on a tear since the middle of March. That stock up 16% since March 22nd, 23rd. Kellogg CEO Steve Cahillane joins us now, fresh off of that earnings call. Steve, thank you so much for joining us. Very strong sales over the past quarter, especially over the past month. Tell us a little bit about what you saw from the consumer.
Good morning. Thanks, Sarah. Thanks for having me. First, I'd like to start by
talking about what the most important priorities are for us. And that's how we can deliver in the marketplace. Keeping our people safe is and has been the number one priority. Getting food to the marketplace in the most efficient and effective way possible, allowing us to perform in the marketplace. And then finally, giving back to communities, which is incredibly important. And that's allowed us to keep our factories running really flat out around the world, 24 hours a day, 7 days a week, breaking production records each and every day. You know, I couldn't be more proud of our supply chain team and what they've been able to do, what our suppliers have been able to do in getting us the raw materials, and what our customers have been able to do in terms of keeping their customers, consumers safe, operating in this incredibly difficult environment. Because what we've seen is companies like ours are really being sought out by consumers as obviously they shelter at home. They look at brands they trust. They look at affordable foods that are convenient. And so we have seen an incredible rise in demand, but it all happens because our people are safe. They're able to operate. Our customers are leaning in with us, creating this environment that nobody could have predicted just a few short weeks ago.
Nobody could have predicted 45% growth in consumption for Eggo waffles in the month of March. Steve, the question, though, that investors have, and you must be trying to figure out, is how long-lasting is this kind of bump and the return to growth for businesses like cereal or frozen foods, which were so weak before this crisis and now have some life, but as the economies start to reopen, we wonder if you can still continue to grow in those kind of categories.
Yeah, it's an important question and one that we're spending an awful lot of time studying. And so what we do know is people are obviously not only buying our products in much greater rates, but they're also consuming them. So it started with a real pantry load, but the food is being eaten, and it's being eaten in ways that are leading people to reappraise the category, to discover the category. And so if you start with ready-to-eat cereal, one of the interesting things that we're seeing is increased penetration across all demographics, across all cohorts. And we're also seeing consumption increase in different occasions. And so one of the number one occasions that cereal is actually growing in is cereal for dinner. And so it's growing at breakfast at double digits, but it's growing as a dinner replacement as well, and a snack. So we're seeing it growth across all occasions. Our strongest, most loved brands are growing the most. And so how much of this sticks, obviously, is an important question. But we're working very hard to not only make this an accident where people are eating more of our foods, but having a purposeful program where people will, stay with our brands as things get back to normal. Now, when they get back to normal and how quickly that happens, obviously it's going to be staged. Nobody really knows, but we can expect that people will be eating more meals at home for quite some period of time.
Is there any way to tell whether people are eating cereal, whether it's for breakfast or for dinner, because they want to or because they have to?
Well, most of our data suggests because they want to. Now, they're at home because they have to, so it's a bit of an intricate question. But when they're at home, they're eating cereal multiple times a day, and they're doing that because they want to. So they're home because they have to be, and they're eating cereal because they want to, and they're rediscovering the joy that they have in cereal, the appreciation for how convenient it is. Some of the things that we're picking up are how easy it is to clean up. And so people are making a lot more meals at home, and means they're doing a lot more dishes. They have time to do that. But they also look for things that are convenient, that require less cleanup. Another thing that we're picking up is it satisfies the desire of the entire household. So kids love it. Parents love it. It makes the whole family happy. And so, I know in my household, it's hard to find something that everybody likes. All my children like broccoli. I don't. But everybody loves cereal.
Although, Steve, I don't know, I don't want to speak for Sarah, but what you might have been getting at is over the longer term strain on household budgets. There's been some data points out of restaurants where they're seeing stimulus checks now being used in the month of April. I guess, what does that mean for pricing over the medium term and the longevity of, say, premium products versus cheaper options?
Yeah, it's obviously, as I mentioned, watching the unemployment figures climb to the levels that they are it's just heartbreaking, right? And so, my personal thoughts and prayers go out to everybody who's going through these trying times. And we're studying as a company what happens during recessionary environments, which is obviously what we're in, when household budgets become very strained. And, one of the things that people go to is what's economical. And cereal tends to be, and our snack business, our frozen food business, you mentioned Eggo, all tend to be very affordable at-home foods. And so one of the things we've learned in past recessions is companies and brands that hunker down and don't invest in their brands through brand marketing and innovation especially don't win. But if you continue to delight your customers and innovate despite tough environments and really focus on the affordable nature of your food offering, and ready-to-eat cereal is an incredibly affordable meal solution, it's a winning, it's a winning hand. And so it's a terrible crisis that we're going through, but, we're going to be there for our communities, and our foods are going to be there as very affordable solutions for all families in the United States and around the world.
So why did you reaffirm guidance? Why did you keep it the same despite, 8% organic revenue growth?
Yeah, we're in an environment where it is just incredibly uncertain, as you all know. And we're one of the few companies that has actually affirmed guidance versus withdrawing guidance. And I understand why companies are withdrawing guidance. They're withdrawing guidance because the future is incredibly uncertain. And so we have affirmed guidance because the first half of the year, our sales are quite strong, and we're not sure how long that continues and at what rate it continues. We have a degree of confidence in our business, but we also know that the second half will not look like the first half, and we're deferring investments that we would have made in the first half of the year to the second half. So in the first half, we have very high sales, lower investments. In the second half, we may have lesser sales and higher investments. We also have emerging markets where we have, significant businesses that are also uncertain. And so we think it's the prudent approach to affirm guidance, not do anything other than that, and make sure that we have the financial flexibility to do the things necessary to continue to build a stronger business so that when this is all over, our business is stronger than it was when we went into the pandemic.
You just mentioned deferring some investments. Steve, how have plans changed? Marketing, for instance. How much are you pulling back on advertising, whereas you would have normally done? Potentially delayed any product announcements or new innovations? Have the
Facebook is trying to target everybody listening to you today. We're all working together listening to you today. And suddenly travel, just like the Four Seasons in Budapest, stopped advertising. That's okay. They can sell all of us to the jeweler.
Step-by-step guides to help you set up online and mobile banking,
which is safer and easier than you may think.
But for those that really need to see us in person, we're keeping as many branches open as possible.
So however you need us at the Halifax,
we're here to help. Terms and conditions apply. For more information, go to halifax.co.uk.
Quarter that will be dramatically different and really characterized by more supply-driven, less demand-driven, hence less commercial activities and commercial investment, and a second half which we aim to make a little bit more normal. But again, there's so much uncertainty in the marketplace that we feel like we should get some credit for at least affirming guidance and not withdrawing guidance. But that's in the context of how much uncertainty there is in the world today.
Well, I think you are getting credit. Your stock's up 3.5%. Steve, thanks for joining us. Steve
Thank you guys very much. Stay safe. Appreciate it.
CEO of Kellogg, Carl. I don't know, but we've always done breakfast for dinner, including cereal, not just during these times.
Right. Well, now you got company. Dow's down about 215 as Boeing's in the lead, up 3%. When we come back, we will get to former ECB chief Jean-Claude Trichet. Don't go away.
With With the NHL season temporarily on ice, now is a good time to catch up on past games. With Game Replay on TuneIn, you can hear every matchup of the 2019-2020 season so far. And for a limited time, it's free for hockey fans everywhere. Search Classic Game Replays to start listening.
Fox, in case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn. Wi-Fi connection spotty? Make sure you're never without something to listen to by offlining your podcasts on TuneIn. Just find your favorite podcast and tap the three dots to download the episodes you want to hear. When you're off the grid, you'll find all your offline audio under your favorites.
Behind the highlight reels, championship rings, and colossal paychecks, there are sports stories that fuel, deepen, and even challenge our love for the game. For true tales of underdogs, anti-heroes, and game-changing innovators, search sports documentaries on the TuneIn app. Keep up with everything happening in the wild world of pro wrestling with the TuneIn podcast. For expert analysis straight from the WWE to Steve Austin's no-holds-barred conversations with wrestling's biggest personalities, search sports and scroll down to the world of wrestling to listen.
Hey, it's Jacoby here from Jalen Jacoby, and after you watch The Last Dance on ESPN, which you're obviously going to do just like the rest of us stuck in our homes in quarantine, you can join Jalen Rose and I for Jalen Jacoby, The After Show. And we will be joined by the director of the documentary series, Jason Eyre, to discuss each episode in detail. You can hear our After Show right here on ESPN Radio on Sunday nights after the episodes air, and they'll be available on the Jalen and Jacoby podcast feed.
Search Jalen and Jacoby to listen today.
A social distancing tip.
Putting distance between yourself and others is critical to slowing the spread of coronavirus. So here are ways to stay in contact without the physical contact part. Call, send a text, set up a video conference, post on social media, dedicate a song on the radio. If you have symptoms of fever, dry cough, and shortness of breath, call your healthcare provider before going to their office. For more info, visit coronavirus.gov.
Let's all do our part, because we're all #alone together. Brought to you by the Ad Council.
Let's get to Rick Santelli with Jean-Claude Trichet. Hey, Rick.
Thank you, Carl. Yes, I'd like to welcome former ECB President Jean-Claude Trichet. Mr. Trichet, I thank you for joining me. We've been waiting with bated breath. Let's get right into it. Eurozone GDP contracts at 3.8%, the fastest shrinkage on record going back to the mid-90s. France down 5.8%. That's the worst deterioration in GDP since 1949. And, of course, we see that there is nothing showing up on the Eurobond from Christine Lagarde. What do you see regarding the economy, and how do you think Christine Lagarde and the ECB have been proceeding?
First of all, of course, the economy is shrinking, and this is the consequence of the confinement, as we say. So nothing is surprising, and we have to expect even more contraction, and I would say everywhere, frankly speaking, apart perhaps from the Asian countries. Second remark, the ECB has confirmed its own total determination. I was recomputing what Christine was saying as regards the purchase of tradable securities, and until the end of the year, it's a €1 trillion purchase program. There was total flexibility in the use of the pandemic emergency purchase program, which this flexibility is very, very important in the present juncture. And there has been also a number of additional elements that are also important, in particular the famous targeted long-term refinancing, which is now at the level of -1% for new lending, the interest rates that the banks are refinancing with. Now, last point, the attitude of the governments, and then the message is very clear, and I will, of course, myself say to which extent it is very, very important that the present blockade on the financing of the recovery program, which should be very, very important. The President of the Commission mentioned a €1 trillion recovery program. Whatever the amount, it would be very big, but it has to be decided upon. And whatever the financing might be Eurobonds, it might be another way of finance this recovery program. I would say the important thing is that it is decided. And it is not yet the case, but I would urge myself, and Christine was very, very clear on that, the European governments, the heads of state and ministers, to decide upon that.
We only have a minute left, sir. We're going to have to answer this quickly. Many believe that the chances of the euro surviving have gone down a bit, considering there is no Eurobond/Corona bond. It seems as though the Dutch and the Germans just aren't happy with it. Your final thought, whether both those countries are going to, at some point, concede the notion that shared debt is what's going to ultimately save the Eurozone and potentially the euro. Your final thoughts.
First, there is not only the Eurobonds to finance a joint collegial recovery program. You could do that also through the budget of the Commission. You could do that through some borrowing of the Commission itself. And that's the reason why I say let's not be blocked on the Eurobonds. The Eurobonds are not the only way to finance what is needed. And I am confident that they can deliver, but it has to be done as soon as possible.
Excellent. Jean-Claude Trichet, I thank you for joining me. Stay safe. Carl Quintanilla, back to you.
Thank you. Thank you very much.
All right, Rick, thanks. Rick Santelli. Good morning, everybody. Welcome to Squawk Alley. I'm Carl Quintanilla with Morgan Brennan and John Ford, coming to you live from various locations. Got some moderate losses on the Dow, down about 1%, off of session lows, though, which was down about 378. Obviously, earnings are the big story today, whether it's McDonald's or Twitter or Facebook or Microsoft, Tesla, Comcast, our own parent Morgan, and we're starting to try to dig out some trends here. One is obviously signs of hopeful stabilization in the month of April, while they're also looking at efforts to rein in spending, and in the case of Boeing today, continue to raise liquidity in this 7-part debt offer that's getting priced today.
Oh, it's so true, Carl. And I think that word stabilization is really the key to the story here. It's signs of stabilization versus recovery. And I think that's a key distinction, and it's one that's playing out right now in the market. So whether you're looking at the CEO commentary on earnings calls or in interviews on this network in recent days, not to mention the Fed chair's message yesterday, or even arguably what we're seeing in jobless claims, which are still so painfully elevated right now, but seem to have potentially peaked maybe 3 weeks ago, that the emerging theme is really that economic recovery is going to, at least based on everything we've seen right now and what we've heard right now, is going to take longer than initially thought. But there are still some of these potential signs suggesting that the worst, I say that with lots of caveats and lots of uncertainty still clouding everything, that the worst is over, whether it's the comments we got from Facebook on that earnings call yesterday, or Alphabet earlier in the week, or even Macy's, which is reportedly looking to open its roughly 775 stores in the next 6 weeks potentially, but still expects that those stores that come back online first to really only operate at about 1/5 of their normal sales volumes, at least at first. So that being the key, stabilization versus how long this recovery is actually going to take to play out in the coming weeks, coming months. John?
Yeah, I hear you, Morgan, and I agree with your general takeaway, but I got to say, I also think that a lot of this stabilization that executives are talking about is predicated on the idea that things start to open up in June, and that as a result 100%. Of that, we don't end up with some big step backward in terms of infections and having to go into a second phase of lockdown. And another takeaway that I'm getting from this earnings season is that there's certain set of big tech companies. Some of that includes what we've called the FANG stocks, but they have a lot of cash. They're pretty dominant in their markets. They tend to have diversified portfolios of business, whether it's cloud, subscription revenue, et cetera. They're doing unusually well in this environment. And for the people who are concerned about high valuations heading into this, and was it a repeat of the .com meltdown scenario, I think at least with this first shock, it seems the answer is no. I mean, look at Microsoft and how well it was able to balance the advertising-related losses in search and LinkedIn versus the strength in Azure and 365. You know, look at Qualcomm and what it was able to do, which we're going to talk quite a bit more about in just a moment. Look at Facebook and its ability to see some stabilization in April because of some direct response advertising versus some of the other categories that are less stable for them. So, Carl, I think it's a really interesting but varied picture.
Yeah, indeed. I mean, there are companies that, to your point about Microsoft, have huge utility in the occurrence of a national or global pandemic. Contrast that with some, obviously, the targeted areas like retail and restaurants, where you have, in the example of McDonald's, 100% of stores in China now open, but traffic still subdued. So we come back once again to the question of, even though a reopening may have occurred technically, to what degree are consumers comfortable leaving their homes and getting back to business?
Yeah, and that's going to be the key question. It's going to be the one that plays out in terms of all that economic data. Certainly we saw it with that first read on Q1 GDP as well, with negative 4.8%. That was led lower by personal spending. And you take that, you look at the jobless claims, more than 30 million unemployed now. And you got to wonder how this is going to play out, how painful these numbers are going to be in the coming weeks, and thus how confident consumers are going to be to come back. Also, one to watch in terms of this, John, is going to be something like Operation Warp Speed, the government's push right now to try and get vaccines, hundreds of millions of vaccines ready by January, which would be absolutely unprecedented and one for the history books, and would probably make a big difference as well.
Yeah, that's important. In the nearer term, of course, we've got Apple, Amazon, and Visa earnings, which are going to give us looks at very important large companies in their categories. But for now, one of the big earnings movers this morning is Qualcomm, up and then down and now up again, about flat. The company reported earnings and revenue beats last quarter. Forecast of the current quarter will see a 30% drop in smartphone sales. At the same time, it is sticking to its projections for 5G shipments this year. And joining us now exclusively on those results is Qualcomm CEO Steve Mollenkopf. Steve, great to have you. Good morning.
Thank you, John. Good to be here.
Well, I want to talk your specific quarter in just a moment. But first, you've got a great view of the big picture, so I want to go there. I heard two signals from you last night that on the surface might seem to be conflicting. On the one hand, smartphone shipments severely impacted in the first half, down 21% last quarter and expected 30% this quarter. But on the other, you still expect a robust 2020 for 5G. How are both happening at once?
Well, I think you have to look at the only data we have really that's firm is what happened in China, and they're a little bit advanced, of course, relative to the rest of the world in terms of when this pandemic hit them. And what you saw was a pretty big drop in the March quarter, but then really well on the way to recovery by the time you got out of March and certainly into the quarter that we're in. And we see that in orders, we see that in handset reports from our licensees. And if you project a similar model to the rest of the world, and that model is backed up not only from what happened in China, but also kind of what you see in terms of exit rates leaving the March quarter. We have some visibility because of our chip orders. We also have estimates from some of our licensees. You lead to a view that, yes, we are going to see a pretty good drop in the June quarter. But we do expect that to, on at least to how it exits June, to be in a much better position. So much so that we feel confident with our 5G forecast for the calendar year. Now, part of that is really being informed by the intensity with which the operators and primarily the handset vendors are pushing us to make sure that we're keeping our schedules and make sure that we're launching phones on time. So I think there's definitely a big impact to the near term, but long term, these trends are, we think, quite positive for our business, and we think for others as well.
That definitely is a positive signal, Steve, on the idea that the OEMs are still going to launch these phones and are pushing you to do that. But I wonder, give us a sense of what that signal really means. Because it seems to me, if I'm an OEM and I think there's any chance I could still launch my phone this year, I'm going to be pushing you to deliver on time, even if I don't think it's a great chance I'm going to launch this year. So are you picking up a signal that they're still hoping to launch this year, but it might be a distant hope? Or can you be certain that that's what they really expect to do?
Well, I mean, it's both past and future. I mean, if you look today, even in the quarter that we just reported, we kept phone launches on time based on our deliveries remaining on time and people wanting to launch. And you got to remember the view primarily from the Asian OEMs is that, wow, we are through this and now we need to get back to normal sell-ins. And if you look at the intensity with which the Chinese OEMs and the Chinese market is pushing 5G, which is 70% of the new handsets that are being sold are 5G related, and they're already back to more normal levels of sellout. You can see why they would have a lot of intensity, and even worldwide, with the exception of, I would say, Northern or Europe having some, obviously some difficulties, significant human toll there. The deployment schedules that 5G is on are still being pushed with a lot of intensity. So I think this is real. People trying to meet launch timings, making sure that we have it, making sure we have supply. Things like the supply chain are humming, and now it's just a question of how does the consumer respond.
Tell me more now about China and the degree to which we can extrapolate that out for the rest of the world, specifically when it comes to how this crisis affected smartphone sales. Did the behavior change affect all price points equally when it first hit? Were people buying lower-end phones more, or higher-end phones more? And then when you're seeing it starting to come back, are all price points coming back equally, or is it coming back more on the lower or higher end?
Well, I think it's fairly broad. There are really two trends. One is that it responded, or it came back much more quickly than we expected, meaning that it's recovered very quickly. It also, the penetration level or the price point that is now 5G is actually extended down, and so I think it's been a broad-based recovery. And we hope that's the same thing in the rest of the world. We've given our model for what we think will happen. We hope it's helpful. There's obviously a lot of uncertainty in what could happen, but that's what we're planning for as a company. We think the technologies of 5G, the trend of being connected more, that's the thing that we've learned through this episode, and we have to be prepared to take advantage of it.
Yeah, one thing that gives me pause is that China's policies for testing, for quarantining and locking down and then opening back up have been different from the rest of the world. So I wonder whether the recovery in the rest of the world can track the same way. But tell me, how soon are you going to know whether the recovery in the rest of the world is tracking the way it did in China?
Well, we're obviously fairly far into the quarter, and things like chip orders for us are well known and fairly firm. There's always an estimate in terms of what the licensees will actually sell in the quarter, but we have a pretty good sense on what that's going to be. But it's really the question is, what is the exit rate coming out of June, and what does the shape of the curve? How does the consumer respond? And I think it's also important to remember that the phone sale, depending on where it is in the world, has a different mix of online and offline, meaning whether you have to come into a store or not. And so there's a lot of variables that mix up into it, but this is our best view as to what's going to happen, and it's informed by not only chip orders, but also what our licensees are telling us.
Hey, Steve, we've been talking about geopolitical tension and friction between the U.S. and China for a while now as it relates to the industry, but now this week you're getting even more headlines about Pompeo and probes into the origination of the virus and so forth. Do you expect rising walls between the U.S. and China to be material to the business?
Well, I would say you have to kind of look at the level. The short answer is, I think in our industry, the focus is on launching products and technology. And the reality is we work fairly well together in order to do that, from the standards bodies all the way into the delivery of products. It's a fairly there's a lot of co-opetition that goes on, which is very normal. And by the way, not just isolated to China. There's always there's a lot of cooperation as well as competition. But I don't see that as the narrative that's dominating the workflow. If you look today, it's all about get these devices out on time, help me become a global player, and how can we make sure that the industry and the world is ready for 5G. So I think it's probably a discussion at the parents level, but at the kids level, which is where we play, we're still focused a lot on our work.
Steve, as the CEO of a major company that has operations all over the globe right now, What are the factors? What are the data that are shaping your decisions about how you are making decisions around production, how you're making decisions around where your workforce is going to be located and for how long? How important are things like testing to that equation?
Well, I would say we're in an enviable position because we have sufficient liquidity and we have a strong balance sheet. And so really our focus is making sure the company is prepared to take advantage of really the benefits of 5G. And although we're obviously in a very difficult position as a country and the world due to the Corona-19 situation, but it did do one thing. It proved to everyone that this work from home, educate from home, telemedicine, all of the things that 5G can bring at scale in terms of fundamental technology is very important. So we are spending a lot of time making sure that we are prepared when this thing snaps back to take advantage of it. And even in the way in which we're working, it's consistent with that. So we had a lot of people working from home, still making productivity, still launching phones, still fixing bugs, still taping out chips, doing all of this work, a tremendous amount of productivity. And a lot of our employees are basically saying, this is working so well, could we continue to work like this even after we have the ability to come back? And I think that's going to be the trend for a lot of places, and we want to make sure that we're ready to do that. Our geographical separation or our spread around and how we do work has actually helped us have the infrastructure in place to respond to something like we've had to over the last quarter. But I'm not sure the world's really going to go back to what it was before, and it's probably going to use more and more of the technologies that we're inventing. We need to be prepared for it.
Yeah, and you've talked about that. You've talked about kind of the wide range of risks that we still face. What type of defense is Qualcomm prepared to play in the second half if we hit more rocky terrain? You talked about the strength of your balance sheet. How are you prepared to either manage costs or shift things around should you need to?
Well, I think like any company, we have levers that we can pull, but I can tell you that primarily the discussion is how do we make sure that we're prepared for the upside and the snapback whenever it should occur. But like any other company, we have levers that we could pull if we had to. But I can tell you the emphasis is much more on the opportunity than that downside concern.
Well, and I've been saying I was looking forward to the data to come out of earnings season for a while, and this is some of the best that I've seen that just gives a look at the entire technology landscape. So I'm grateful for that. I also wonder, what is it, as a business leader, as a technology leader, what is it that you want to see, whether it's from governments, whether it's from other institutions, that you think would help to lift all of us out of this situation as quickly as possible? And I'm talking in terms of whether it's testing, whether it's policy. What would help you?
Well, I think, if you look at the way a company runs, looking inside, this environment is one that you don't have a lot of strategic uncertainty as to which way to go. You just have to get through it. What you're working on is very important. Make sure you're prepared to take advantage of it. I think the next phase that business leaders are going to be looking for is how do we make sure that the psyche of the consumer is repaired as quickly as possible. And I think that's one of the more challenging aspects. I don't have any great idea as to how to do that, but I think that's the thing that will have the biggest impact to business worldwide. Is not so much how they operate internally, but how does the market repair itself? How does the consumer feel comfortable to do many of the things that the broad economy needs for it to be successful?
Good insight. I think we here at CNBC believe that reliable information is a key part of building that kind of confidence. So thank you for doing your part and providing it. Steve Mollenkopf, CEO of Qualcomm.
Thank you.
Well, coming up after the break, Microsoft's head of gaming and president of Xbox is going to join us in just a few minutes. Don't go anywhere. We're back in 2.
Keep up with everything happening in the wild world of pro wrestling with a TuneIn podcast. For expert analysis straight from the WWE to Steve Austin's no-holds-barred conversations with wrestling's biggest personalities, search sports and scroll down to the world of wrestling to listen.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
While you wait for baseball season to begin, TuneIn has dug into the archives and blown the dust off some of the classic games in MLB history. Search Classic Game Replays to relive some of the great contests in America's pastime. It's on demand, it's free, and it's only on TuneIn.
They say singing can help you remember things, so here's some tips for parents out there during these tough times.
Number 1. Make sure your kids wash their hands for 20 seconds after they've coughed or sneezed or been outside. 2. Virtual play dates. Social and physical distancing can help save lives. 3. Tell them they're safe and show your love and pride. Yes, we'll get through this together.
Find out more at coronavirus.gov. A message from the CDC and the Ad Council.
Want to relive the glory of college football?
Balls over a man, into the end zone.
Come explore TuneIn's Classic Game Replay collection to hear ESPN's complete coverage of the 2019 New Year's 6 bowl games. Don't miss your chance to re-experience the Rose Bowl, the 2020 National Championship, featuring Clemson and LSU.
There's going to be 2 champions on the field tomorrow night. There's going to be 1 team hold up the trophy.
Search Classic Game Replays to listen for free.
With so much of our lives spent at home, are you listening to TuneIn all the ways you could be? With compatibility on your phone, tablet, computer, sound system, smart speaker, smartwatch, smart TV, game console, and more, chances are, if there's a time and a place you'd like to hear the TuneIn audio you love, there's a way to hear it on all the devices in your life. Go to TuneIn.com to discover all the ways you can listen.
Welcome back. Microsoft getting a boost this morning after a beat on the top and bottom line, saying the COVID-19 outbreak had minimal impact on its results last quarter, while also seeing increased business in a number of its segments, including gaming. Xbox seeing record engagement, and Microsoft's Executive Vice President of Gaming and Head of Xbox, Phil Spencer, joins us now. Phil, thanks for being with us.
Thanks, Morgan. How are all you?
Doing well, hanging in. So when I see all-time record engagement for the quarter, nearly 90 million active users of Xbox Live, talk me through what you've seen in terms of the demand and how much of that was existing users versus new people coming to the platforms.
Yeah, absolutely. I mean, we've obviously believed for a long time that gaming is just one of the most social and interactive forms of entertainment on the planet. Microsoft's been invested in gaming for quite a while. And at a time where people are physically distanced from their friends and their family, the fact that so many people are now looking at gaming as a great social outlet, I think is just testament to what gaming means. Like you said, we've hit nearly 90 million people on Xbox Live. We've seen our subscription services like Game Pass reach over 10 million subscribers. It's really just becoming a strong social fabric in the home at a time of need, which I'm glad we can be there to offer that service.
How durable is that fabric? I mean, when things like sports start to come back online, people start to be able to go outside as some of these shelter-in-place restrictions are lifted. Is this a tipping point? And I guess in terms of more broad-based mainstream adoption of gaming, or will some of that start to slip away again?
Yeah, I mean, obviously, as the world starts to shift back to more of a normal state, we'll see some moderation in certain things. But gaming already, prior to all this, a third of the world's population plays video games. Half the connected world, the gaming business is nearly $200 billion top line business globally. So it's a big business already. And I think what you're finding and what we're seeing now is people creating friends through their gaming experience, family families playing in the home. We've had over 23 million new friend relationships built through Game Pass as people are sitting at home building these digital relationships with people, socializing through video games. So I'm sure there'll be some moderation, but I also think gaming activity, whether it's in the house, the family together, or people playing online, is just going to continue to grow as it was before the C-19 pandemic.
Hey, Phil, it's John Fort. Great to see you. Tell me,
hey, John.
How is this crisis affecting your plans for the launch of the Xbox Series X? Still the same date? Still the same volumes?
Great question. Yeah, I mean, we're learning every day. I say over and over, the safety and security of our teams is the most important thing. Obviously, creating safety for our customers online with our services, critically important. As you look specifically, it's an exciting year for us. We're launching an Xbox this year. That drives so much excitement on the teams and in the community. Teams are doing a really good job on keeping our hardware on track. I'd say that the bigger unknown is probably the game production, just being honest. Game production is a large-scale entertainment activity now. You have hundreds of people coming together, building assets, working through creative. On the hardware side, we feel good about our plans, and we feel like our plans, there's obviously some impact to schedules, but overall, I think we're in line with where we thought we would be. On the game production side, we're learning every day. I still feel good about it. But I also need to make sure that the security and safety of the teams is the most important thing and not unduly push when things just aren't ready.
Yeah, Phil, that was exactly where I was about to go with you, is the content pipeline and what that's going to look like. The other big focus, though, I think is competition. Obviously, Microsoft is a giant in this space. Twitch, which is owned by Amazon, Facebook has unveiled more of its gaming plans, Apple as well. How fierce is the competitive landscape right now, given the fact that there is so much more opportunity for more people to come and use these platforms and be engaged in a more meaningful way?
Yeah, I mean, we're seeing, as you said, the big tech players come in and see this gaming opportunity. We really think in order to achieve success, you need great content, a large gaming community, and more we're leveraging our cloud assets at Microsoft to deliver our products to people on the devices that they already have. And we have a long history. It's why the 90 million people on Xbox Live is really an important metric. A community of people that are already coming to Microsoft looking for their gaming entertainment, looking for their great games, those great Minecraft experience, whether it's education as kids are learning from home or playing with friends, playing Halo online. We have great content from our first party and our third parties on our platforms. We have a large community. And this cloud asset, which is something that we're really leveraging right now, the partnership between Xbox and Azure is very strong. We have hundreds of thousands of people, even in our preview. We haven't even launched our cloud streaming in a general availability yet, but hundreds of thousands of people that are playing Xbox games with their community via Project xCloud. And as we look forward, I think the competition is going to be there, just like you say. But I think our long history in gaming as Microsoft, building up this community and the large content base, along with our strength in Azure, makes us uniquely positioned.
Yeah, Phil, earlier you mentioned the social aspect of gaming. And I got to say, in my household, I got a 9-year-old and an 11-year-old, and that's probably the biggest change that I've seen, whether it's Fortnite or Minecraft. They're, connecting with friends and playing. But I want to ask what you're learning watching that and other things. How has what you're seeing in this surge of usage, this surge of social, how is that going to change the way you develop platforms in the future, whether that's how people interact in games or the way games are delivered, the way people purchase them?
Well, I'm glad your kids are having a good time playing, John. Some of the things for us that have just been foundational to being Team Xbox is, as I said, the safety and security of our community. And we invest a ton every day in ensuring that as kids are coming online, whether it's to play Fortnite, Roblox, Minecraft, that we have an environment that is protected, where parents, through the parental controls mechanisms that we've put in place, feel like they have control of who their kids are playing with, what content they're seeing, how long they play. We have family timers that people could put in place. Those things are really the bedrock for the growth that we're seeing now. because I think those things have to be in place, and we have a long history with those in place. As we grow right now with so many people coming online, I just think that's such a great baseline for us. But your question about new things that we're seeing, I do think this thing of people finding their digital friends, finding people who have shared interests online. People like to play Fortnite, like to play, build things in Minecraft. We're seeing incredible things like, I don't know if you saw the students at MIT rebuilt the full MIT campus in Minecraft. People had never played together, being helped by people who had played, people coming together to achieve things online. And as you say, as people are going outside, I'm sure some of that will moderate. But I also think we're seeing these digital friends, these gaming friends, that social and community really grow. And it's not just 3 or 4 markets. When you think about something like Xbox Game Pass, it's actually in 41 countries today. And then you think about streaming and taking this experience that we're building to continents like Africa, to countries like India, where people they don't have gaming PCs, they're not buying gaming consoles, and yet they want to experience the same social community that your kids are playing as they're playing. And we can really connect the world through our networks and through the power of play.
Hey, Phil, I wonder, with schools closed, have you seen the average user get a lot younger? You have to imagine that some of these kids are not studying as much with online learning. And then on live sports, is the return of live sports a liability from a mind share standpoint, or is it good because you just need to keep enthusiasm about sports alive?
Yeah, on the education point, one of the things we identified early on in the kids schooling from home was parents who needed and were asking for some help. And what we did, we have a product, Minecraft is one of our biggest games, and Minecraft education is an incredibly important component of what Minecraft is. So we actually created in our community marketplace a specific educational forum so parents could go up and find the best educational content that the community had created for Minecraft. And we're actually gave some of those packs away to parents so they could, as my kids are at home, as your kids are at home, and hopefully they are studying. And Minecraft is this interesting merge of, are you studying or are you playing? I think that's the magic equation for teachers and parents is to have something that's a little bit of both. On the sports side, the relationship between sports and gaming has always been strong. The athletes play. We have a ton of Xbox fans and the athletes, and we want people out playing. It's not everything should be in moderation. We love that gaming is out there as an alternative for people, especially at a time like this, but people playing in the home, people playing with friends they find online. We do see an uptick in people's interest in esport right now because there's not physical sports that are out there. And some of these behaviors and some of these interests that people are learning during this time, I do think will stick with them.
All right, Phil Spencer, thank you for joining us today. Shares of Microsoft are up 1% post-earnings.
And now let's get the latest on the coronavirus. Sue Herrera has an outbreak for us, outbreak update for us.
Exactly. Thank you, John. Good morning, everyone. Here's what's happening at this hour. Ford has now made 10 million face shields, shipping to all 50 states as it produces one every 10 seconds. Flight bookings in China are surging today after Beijing relaxed some travel restrictions ahead of the May Day holiday. More than half of the inmates at a federal prison in Southern California have tested positive for the coronavirus, and 2 have died in what officials call the worst outbreak in the federal prison system. The USS Theodore Roosevelt is preparing to return to sea after a thorough cleaning and with a new crew. Hundreds of sailors on board tested positive for the coronavirus earlier this month. As always, you can get more on our coverage by heading to CNBC.com. Morgan, back to you.
Sue Herrera, thank you. The CEO of Slack on the other side of this break. Stay with us.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
Keep up with everything happening in the wild world of pro wrestling with a TuneIn podcast. For expert analysis straight from the WWE to Steve Austin's no-holds-barred conversations with wrestling's biggest personalities, search sports and scroll down to the world of wrestling to listen.
Get the latest breaking news alerts and listening suggestions for new stations and podcasts. Let TuneIn keep you in the loop with push notifications. Just go to your device's settings and allow push notifications from TuneIn to get live alerts and recommendations on the audio you want to know about.
Behind the highlight reels, championship rings, and colossal paychecks, there are sports stories that fuel, deepen, and even challenge our love for the game. For true tales of underdogs, anti-heroes, and game-changing innovators, search sports documentaries on the TuneIn app.
Hey, it's Jacoby here from Jalen and Jacoby. And after you watch The Last Dance on ESPN, which you're obviously going to do just like the rest of us stuck in our homes in quarantine, you can join Jalen Rose and I for Jalen and Jacoby, The After Show. And we will be joined by the director of the documentary series, Jason Eyre, to discuss each episode in detail. You can hear our after show right here on ESPN Radio on Sunday nights after the episodes air. And they'll be available on the Jalen and Jacoby podcast feed.
Search Jalen and Jacoby to listen today. Want to relive the glory of college football?
Pulls over a man into the end zone.
Come explore TuneIn's classic game replay collection to hear ESPN's complete coverage of the 2019 New Year's 6 ball games. Don't miss your chance to re-experience the road.
Framing today.
Want to get to our Deirdre Bosa this morning with a very special guest. Hey, Dee.
Hey, Carl, thanks for that. Yes, that's right. We have Slack CEO and founder Stuart Butterfield. Stuart, hope you're doing well, and thank you for joining us.
Thanks for having me. Great to be here.
Now, it's been more than a month since you recommended that all of your employees work from home. You, along with a bunch of other tech companies, were early to this trend. And you recently said that you won't fully reopen offices until September 1st. So, Stuart, what does that look like? What needs to be in place for you to get back to some kind of normal and have your employees go back to work?
I think the real answer there is I don't know. There's so much uncertainty at this point, and I think people really like to collapse that uncertainty because it's an unpleasant state for humans to be in. And I see compelling arguments on all sides. I think we still need a little bit more information. And what we're saying ultimately is that we don't expect to be back to normal until at least September 1st. So we're not going to expect or require employees to come to the office. We may before then open the offices to make it available for employees who need to get out of their house. But I think there's just, still so much we don't know.
Right. Are you encouraged by trends that you're seeing? Do certain testing requirements need to be in place for that to happen? What are sort of your indicators to know when it is time?
Well, ultimately, an organization like ours who is surviving well, working from home, in other words, we're still productive, we're still serving customers, we're still making new developments, has much less of an incentive. There's no reason, there's no prize for being first here. So I don't have any specific expectation or requirement. It's a little bit more just wait and see.
So, Stuart, on Microsoft's earnings call last night, Teams was mentioned 42 times. That was up from just 9 times the previous quarter. Even Azure was mentioned less yesterday at 35 times. So it really sounds like Microsoft is pouring everything into Teams. Now, I know that the competition is fierce, but at the end of the day, Slack has substantially less cash on hand, less of a reach into the enterprise space. Are you ready for this battle to heat up? Are you seeing signs of it yourself?
Well, I don't know that. I think what we've seen over the last couple of months is that Teams is not a competitor to Slack. I mean, they talk about the product. They never mention the fundamentals that Slack does. And it's been 3+ years at this point that they've been bundling it, giving it away for free, talking about us. And over that time, we've grown our entire enterprise business. All of our grid customers, all of our customers with more than $100,000 in revenue have come up during that time. So I think there's this perpetual question, which is at this point a little puzzling for us, that at some point Microsoft's just going to kill us. I mean, in another sense, they got to be a little bit frustrated at this point. They have 250-ish million Office 365 users. They just announced this massive increase in growth of Teams to a little under 30%. So after 3 years of bundling it, pre-installing it on people's machines, kind of insisting that administrators turn it on, forcing users from Skype for Business to switch to Teams, they still only have 29%, which means 71% of their users have said no thank you.
Hey, Stu, it's John Fort. Good to see you. I wanted to ask you some more about that competitive dynamic, because in some sense it's the classic best of breed versus large incumbent battle. But I also think it's hard for us to see and understand sometimes how you view the competitive landscape and the path to the customer. So right now, when so many customers are now aware of the need for a product in your category, what's your approach? What's your strategy for converting customers and just in general continuing to grow your base?
The same stuff that we've always done. So Slack very often starts in a large organization. Even our biggest customers, which now have hundreds of thousands of daily active users, paying us $1 million or more a year. They start with a work group. They start with someone who thought, I can improve how this happens. I can improve communication inside of this team or this business unit or this organization. Slack usage grows. We get in touch with them because for a large organization, it's obviously it can be a complicated thing for people to buy software. There's the security review and vendor approval process. There's a whole bunch of implementation details and administrative stuff, maybe regulatory compliance features that are a requirement for them. And in that environment, it can take many, many months. So we have sales, solutions engineering, customer success teams that work with these large organizations to do enormous deployments.
So what is it that you have to do that's different then? I imagine there must be something, even if you're able to work well from home, your customers are probably in different locations, their processes are different.
I'm sorry, I might have misunderstood the question. It's very different. In some cases, it actually seemed a little bit more effective. Like for me to come on the show, typically I would have been in New York. I would blow 45 minutes going all the way uptown to the studio, spend some time in the green room. I'm going right back to work after this. And I just finished something else immediately before this. For our customer success teams, they're actually more efficient right now because customers, in one sense, are really paying attention because suddenly this is an urgent issue for them. And we don't have to travel. So, you might, for a 2-hour meeting, there might have been 14 hours of overhead. Now, does that sustain itself? That's really hard to say. And kind of looking further out, second half of the year, field marketing programs are not running, events are not running, our executive briefing centers are closed, but we're in the same position as everyone else. And I guess you got to ask yourself, are CIOs, our IT teams going to be spending less net on software, 6, 12, 18 months from now? Maybe at the margins, maybe temporarily. But I think if anything, this has really accelerated the digital transformation, accelerated the adoption of software. And I think we come out of this whenever we do, which could be 18 or 24 months, in a much stronger position. Us and the whole software industry, frankly.
Yeah, Stuart, this is Morgan. I guess sort of along those lines, I mean, obviously Slack has been very focused on business and workplace, whether it is within the office or whether it is now increasingly folks that are working remotely. I wonder with so many other types of entities, institutions, and industries also remote right now and the possibility, and I'm thinking of like Harvard, for example, saying that there's a possibility that they're going to be doing classes online come the fall as well. Do you see other opportunities to expand into some of these other areas as well? Could they be potential future revenue streams for you?
Yeah, we actually do pretty well in education. I'm not sure which customers are allowed to mention there, so I saw, but most of the Ivy League, most of the most famous universities in the United States, some big state schools like Arizona State is a customer. Now, it's not Slack is kind of an open messaging platform for students because I don't think that would be that useful, but deeply integrated into the faculty, the administration, and the delivery of educational materials. I think that is a significant market for us, and it also exposes Slack, obviously, to students, which is great. Thinking a little bit more broadly, organizations are being forced to do things in a different way. And one of the things that becomes more important when you kind of, if you're an organization that is reliant on in-person meetings to get work done, one of the things that becomes more important is more discipline around communication. The cost of coordination and making sure people are on the same page, kind of generating this alignment becomes a lot more expensive. So we look at, recently, just a couple of days ago, we had the CTO of Viacom CBS announced that they rolled out Slack for 20,000 users there. And we think about the merger going on, kind of knitting those companies together in a time when there's the global pandemic happening. There's real challenges. And so it's an honor to be able to help in those contexts, but that's happening everywhere. There's these real challenges that organizations have to up-level how they communicate. They have to kind of rethink processes, everything from new hire onboarding to employee performance reviews to how they run their sales organizations. So given that it's not going to change overnight, I think the investment that organizations are making makes a lot of sense.
Hey, Stuart, it's Deirdre again. Earlier this month, you guys raised $750 million in a debt offering that was upsized. It carried a very attractive interest rate of about 0.5 percentage point. Do you feel like you need to continue to preserve cash or potentially even raise more capital, especially since we're in these uncertain times? Microsoft is ramping up and you can secure it at such an appealing rate.
Yeah, so there's defensive reasons and there's kind of offense reasons for us to do that. One is we don't know how bad things are going to get on the macro. We don't know how long the recession is going to last or what it's going to look like. So having more cash, even though we were already in a very strong cash position going into it with around $750 million already on the balance sheet. But my motivation as one of the people who made the decision was much more on the offense. The acquisitions we can make now, you're starting to see some softness in the advertising market. Our dollars will go further there. I think we're in a relatively much improved position with respect to competition for talent. And we want to be really aggressive there. So I don't know that we could spend any more or that any more of a reserve would be useful at this point, but we do want to be as aggressive as we can while we have this enormous opportunity.
Right. So that capital raise was more of an offensive play. But in terms of a defensive play, a few weeks ago, you also raised some caution about sustainability. You said that it's hard to know how much all of the explosive growth that you have seen is sustainable, given all of the uncertainty that we are seeing. So how is that going? Are you locking down more enterprise deals? What are you seeing among your small business customers? Do you feel any kind of a responsibility to help them out by, say, renegotiating deals or delaying payments?
We actually have done quite a bit of that. And we proactively reached out to some of our customers who we know are most affected. There's a lot of businesses who kind of ground to a halt. Revenue fall 80%, 90%, in some cases like 95%. And businesses who thought they had a year and a half or 2 years of cash on hand suddenly have 45 days of cash on hand. So we're trying to find solutions that work for them. I think the growth is unsustainable in the sense that we would have more than the entire population of the world using Slack, if the rate of increase kept constant. So I think what I'm more concerned about is in the back half of the year, how many layoffs do we see? How many bankruptcies do we see? How many organizations just completely pulling back? And that's what the question mark for us is, because the initial stages of this have been a positive for the business. They've been more new users, more new customers, more usage among existing customers, this expansion. But we are starting to see small businesses starting to pull back. We have 110,000 customers as of our last earnings. So you can imagine most of those are small and medium businesses, and we've yet to see what the real impact is going to be.
Stuart, I want to thank you for being with us today, and I like the new background. I like that you switched it up.
It's the HP Garage.
Guys, I'll throw it back to you.
And Deirdre, thanks to you as well. And now New York State is out with its latest numbers on COVID-19. Here is Governor Andrew Cuomo just moments ago.
Another opportunity God gave us. Hospitalizations are down. Good news. Net change in total hospitalizations down. Good news. Net change in intubations down. Good news. New COVID cases slightly down, 933, but still unacceptable, but down from where it was. Number of lives lost, still terrible, 306. Optimists would say the number's on the decline. Realists would say that's a tremendous amount of pain and grief for hundreds and hundreds of New Yorkers who lost a loved one. Big question, everybody. One is...
That is New York Governor Andrew Cuomo with the latest numbers regarding COVID-19 in the state right now. According to those numbers, everything is trending down, whether it's hospitalizations, whether it's deaths, which do unfortunately continue. We'll continue to keep an eye on all of that, bring you any more headlines as we get them. When we come back, though, the big earnings parade in tech, we're going to break down the numbers we've gotten and the numbers we're awaiting next with the CEOs of Microsoft, Alphabet, Twitter, and more are saying about the impact of the virus and why Elon Musk is so mad about it. Stay with us.
What the excuse me. People, outrage. It's an outrage. But it will cause great harm, not just to Tesla, but to many companies. And while Tesla will weather the storm, there are many small...
With the NHL season temporarily on ice, now is a good time to catch up on past games. With Game Replay on TuneIn, you can hear every matchup of the 2019-2020 season so far. And for a limited time, it's free for hockey fans everywhere. Search Classic Game Replays to start listening.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn. If you've used TuneIn much, you probably already know how to favorite your top stations and podcasts for quick access. But did you know you can organize your favorites too? Under your favorites page on the TuneIn app, hold and drag the stations to rearrange the order to your liking. It's that easy.
While you wait for baseball season to begin, TuneIn has dug into the archives and blown the dust off some of the classic games in MLB history. Search Classic Game Replays to relive some of the great contests in America's pastime. It's on demand, it's free, and it's only on TuneIn.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
Behind the highlight reels, championship rings, and colossal paychecks, there are sports stories that fuel, deepen, and even challenge our love for the game. For true tales of underdogs, anti-heroes, and game-changing innovators, search sports documentaries on the TuneIn app. Keep up with everything happening in the wild world of pro wrestling with the TuneIn podcast. For expert analysis straight from the WWE to Steve Austin's no-holds-barred conversations with wrestling's biggest personalities, search sports and scroll down to the world of wrestling to listen.
Hey, it's Jacoby here from Jalen Jacoby, and after you watch The Last Dance on ESPN, which you're obviously going to do just like the rest of us stuck in our homes in quarantine, you can join Jalen Rose and I for Jalen Jacoby, The After Show. And we will be joined by the director of the documentary series, Jason Eyre, to discuss each episode in detail. You can hear our After Show right here on ESPN Radio on Sunday nights after the episodes air, and they'll be available on the Jalen and Jacoby podcast feed.
Search Jalen and Jacoby to listen today.
It's been a crazy 24 hours of tech earnings, whether it's Facebook, Microsoft, Tesla, Qualcomm, and, of course, Apple and Amazon still on the way. Cowen's John Blackledge joins us today, along with Mark Shmulik of Bernstein, talk about some of the big names and takeaways. Good morning, guys. Good to see you.
Yeah, good morning. Thanks for having me on.
John, I'll let you just do chef's choice and pick an example of a print that is threading out some of the most important dynamics of Q1 so far. What do you think?
Yeah, thanks, Carl. I think there are some common threads thus far for the large digital ad platforms that have reported: Alphabet, Facebook, Snap, and Twitter. You know, while the pandemic has led to accelerating user and engagement growth, it's also caused, this major downward pressure on ad demand starting in March, and that has continued into April to varying degrees depending on the platform. Performance ad units like app downloads have performed better than brand advertising, which has really fallen significantly. Categories that are performing well: gaming, e-commerce, CPG, as people are at home, while travel and auto have declined significantly. And so, with all the puts and takes, it really depends on the business mix when you're looking at the platforms. Like Google Search has high exposure to travel. That led to a 15% decline in their search biz at the end of March. And that's persisted into April, whereas Facebook has a bit of a different mix, and they've kind of benefited from their exposure to gaming, e-commerce, etc. But on the whole, it's actually been better than I think investors and we thought, and you've seen these stocks run up a bit.
Yeah, Mark, I'll throw the same one to you. Is there anything that I guess argues against the notion that April is going to be a trough month on just about any metric you use, except for things like CapEx and headcount and things like that?
Yeah, I think to kind of echo John's point was there's a very clear difference in the stories between traditional call it brand advertising and the more direct response that's driving a digital event or a digital activity. It wouldn't surprise me at all on the latter if we've already passed the trough that was happening in kind of, the mid to late part of March. And we're actually starting to see signs of recovery already on those ad units coming into April. So, brand still feels like it's going down. I feel like Q2 is definitely going to be a trough there. But when it comes to the direct response, at least from what we've seen in the prints and from how management has guided, it looks like it's on the way back up.
Interesting. For so long, John, 20% revenue growth year on year was like this sort of like constant in our lives, right? It was unthinkable that some of these big names were going to get below that. Facebook 17 year on year is the lowest in history, but do we get back into that 20 range?
We don't think so. We have growth in like the low to mid single digits the rest of the year. And kind of to your prior question, Carl, there is no visibility past April. The managements, Google, Facebook, they all reiterated in caution that advertising is highly correlated with GDP growth. We saw the 4 million more unemployment claims reported this morning, takes it to 30 million since mid-March. That's why we're kind of forecasting either declines. We have Google, which is historic, ad decline for the year now, and kind of limited growth for Facebook.
Mark, given the fact that we've got Amazon after the bell, they've been growing their advertising business. And then, of course, there's the cloud business, there's the e-commerce business. There's so many different segments and factors to assess when we get those numbers. What are you expecting, and how have the results we've gotten from some of these other companies so far basically served as potential read-through to this afternoon?
Yeah, absolutely. I think we're looking at across all three businesses and trying to figure out where things land. On core retail, e-commerce, we've seen e-commerce be a net beneficiary so far in the space as we're all spending more time at home. Even if our total retail spend's gone down, the percentage of it that's happening online has only increased. So I think everyone's expecting a reasonably good number there. They may even hint at how April's trended month to date, and some of the numbers we've seen suggest the video game numbers in reality. On the advertising and cloud side, I think with both Google's cloud business and ad strong numbers, I expect AWS to follow suit. And on the ad business, Amazon's been in a unique position where some of the early supply chain issues and disruptions coming out of China may have affected some of the advertising on the platform. Their decision to focus on essentially only selling through essential items. So you kind of cut off a portion of potential advertisers, and those selling likely didn't need a lot of ad dollars against it. So, they may be a touch light on the ad side, but at least the strength that we've seen on the direct response business, which is exactly what Amazon's ad business is all about, you should see some pretty strong numbers across the board.
John, I'll put the same question to you, especially since we got results from eBay already for the week. And then when we look ahead to next week, we get some more of these e-commerce names, smaller in size for sure, but also a key part of the picture, given everything we're seeing right now.
Yeah, people obviously are at home. There's been the shift we've seen in some proprietary data, a big shift, obviously, to e-commerce. And for Amazon, we've been saying it's kind of like, it's such an unfortunate situation, but it's holiday-like demand, right? They added 175,000 people to their fulfillment infrastructure. As a compare, in last holiday season, they added 200,000 people in North America. So you're seeing a flush of demand. So we're expecting very strong results for Amazon and very strong top-line guide. And also, to echo the other points, obviously the cloud business should do fairly well, given what Google and Azure have come out with. And then, advertising's insulated. Most of their ad business is product search. So it should be good. And the stock's been a great stock thus far this year. And I think investors are not as concerned about the margin, like maybe we've talked about in the past, just given the incredible demand environment.
Mark, is a June sort of ramp to reopening of the U.S. economy, you think, priced in to most of these stocks at this point? Because a lot of companies seem to be suggesting that they expect some kind of a recovery to start right around then.
Yeah, that's a great question. And the answer is I don't know. I think what we saw so far with at least how some of these stocks have been performing, I think what we've learned is the bottom feels like we're kind of there and maybe slowly recovering. And that wasn't as bad as people thought. For an example, we saw numbers where some analysts were expecting, Facebook March revenues to decline 20%. And they kind of kept flat year over year. And so that's a big difference in terms of the downside expectations. But I don't know if anyone really has a great sense of when the recovery is going to really kick in and what it's going to look like.
Right.
Even some of the most sophisticated advertisers that we've spoken with that could typically plan their spend 2-3 months out, they're still planning on a 24 to 48 hour out time window. So a very different horizon in terms of how we look forward.
Right. And John, as I'm watching all of this unfold, I wonder, is the regulatory risk to some of these companies now reduced? Because there's been so much focus on how essential they are, and their size in some cases has been kind of a boon to them, certainly, but arguably to a lot of others as well.
Yeah, I'd have to think in this environment that the regulatory risk would be reduced. I think going into this year, probably Facebook was kind of number one target, Alphabet, 1A, and then Amazon less so. But I think in this environment, and I think you heard Mark Zuckerberg talk and Alphabet's management speak about all the things that they're doing to help governments and consumers. So I agree. I think it's pulled back for the time being.
Okay. All right, John, Mark, thank you guys. So much to absorb, and obviously we're not nearly done for the week. John Blackledge and Mark Schmilik on some tech names that we've gotten in the past day or two. Thank you very much. We're going to watch for some comments out of the president. He's been talking to a pool spray, I believe, along with the New York governor about contact tracing in New York State. But now the Washington Post, guys, has a piece up in which they say that U.S. officials are starting to craft elements of punishment against China. For more on this, we'll go to Eamon Javers today. Eamon?
Yeah, this is a Washington Post report, Carl, in which they're saying that U.S. officials are beginning to explore proposals for punishing or demanding financial compensation from China for its handling of the coronavirus pandemic. According to 4 senior administration officials talking to the Washington Post, they're saying that there is a meeting expected Thursday, that is today, to begin mapping out a strategy for seeking retaliatory measures against China. So we'll keep an eye on that, Carl, and we'll get you more as soon as we have it.
All right. We'll look for some more headlines, Eamon. Thank you. Let's get to the half and the judge.
Appreciate it, Carl. Thank you very much. Our breaking news coverage of the markets continues right now. Welcome to the Halftime Report. I'm Scott Wapner. Good to have you with us today. Stocks lower after a pretty good stretch of up days. S&P now still on pace for its best month since 1987. We also got some big earnings on tap tonight with Apple and Amazon reporting. You know we'll be all over that. We're going to do that with our investment committee, which is with me as always. Joe Terranova is here today, along with Josh Brown, Steve Weiss, John Najarian, and Margaret Reed is the senior portfolio manager with the private bank at Union Bank. We begin by going to the boards. Let's check the numbers for you, see where we stand. Bit of a give back, as we said. Dow's off 1.5%, down 370, 24,260. S&P right at 2,900. That's a loss of 1.33%. Russell all the way on your right. Boy, it's been a big outperformer lately, giving back about 3% today. Steve Weiss, I'm coming to you first. We're going to look ahead to those earnings tonight, but we have to look back to last night. You own Facebook, you own Microsoft. No wonder these stocks have been doing so well, and they justified it last night, didn't they?
They certainly did. When Facebook comes out and says, hey, ad revenues have stabilized, that's a very powerful statement. So we've had this debate. Is old tech tired, or is big tech tired, rather? Can it keep giving? And we saw that their operating models are just fantastic. Microsoft, Apple may be the squishiest of all because they're directly tied to the consumer and to phones, but I own it. I'm not doing anything with it. I'll bear through it if it is, a weak quarter. But so what? This is where you want to be. You don't want to be in value. The rotation's not going to happen for more than a day or two or maybe 3. You want to be in what's working, and it's working because the companies are built to work. It's where technology is and where it's going. 5G, as we've talked about so many times.
Funny you say that. Kramer on Microsoft this morning. Some companies were built for times like this. John Najarian, it's your second largest position. You've got Facebook as well. So are we at the point now where we need to discuss the fact that these are defensive names? That's not a new thought by me. Obviously, we've discussed that in the past, but they've just shown you exactly why they are now considered, in some respects, defensive names, right?
Right. And in the case of both of these, Facebook and Microsoft, Judge, they don't have the issues that, for instance, Disney or even our parent company, Comcast, have, because those theme parks, the traffic that needs to go in there, the fact that you don't have sports in the case of Disney. Obviously, these are things that hurt those kinds of companies. But for a company like Microsoft that's got Azure, the cloud and so forth, that has Xbox, which, of course, we saw a dramatic jump in Xbox, people going through that platform, people playing games because they're home more and all the rest. And then that upgrades, not because it's an upgrade cycle, Judge, because of something exciting, but because people had to. They needed more computers at home, whether it was Surface or whether it was even a Dell laptop or whatever it might be. They were using those, and those are on the Microsoft operating system. So Microsoft wins all 3 ways there, Judge. As far as Facebook, one thing about that company is it's extremely sticky. They added 11% growth year over year to 1.7 billion daily active users. That's amazing. And one thing we know is people talk about quitting it all the time. They talk about security, but rarely do they ever leave it. And so an 11% growth like that, double-digit growth for a company this big, is astounding.
Yeah. Margaret, what about the idea of these stocks being tired? It's no newsflash here that these stocks at times have been considered defensive, and that's why the money has continued to go there. But is there any thought that it's time to take some profits in what has been a pretty darn good run for a lot of these stocks?
Well, as it relates to the technology companies all referenced here, between what John's comments and Steve's comments, I would absolutely agree that they, one, can be defensive by the nature of their balance sheets, cash, not extensive debt, the growth rates that demonstrate that these companies can have less than cyclical as it relates to the economy, the economic contraction that we're having here right now, and that coming out of this, maybe the stocks will harvest some, stay here and take some of those gains that they had and led the market here. But in my mind, these are strong companies with the balance sheets that can get us through this crisis. And also, once we get more consolidation in this market rally, potentially lead us coming out of this as well.
Yeah, Josh, let's not forget ServiceNow. They crushed it. Qualcomm, good stuff from Qualcomm, too. Has this just shut the door a bit on the conversation of a rotation, as Weiss was suggesting at the top of the show? There's been a lot of talk that these stocks are tired. It's time to move into cyclical names, play for the rebound. Maybe not.
Well, Steve Weiss correctly points out that we do have these 2 or 3 day rallies in value, and people get really excited because it's like spotting an oasis in the desert. Unfortunately, that oasis always ends up turning out to be a mirage. The mean reversion that some people have been waiting 12 years for fails to arrive or doesn't last long enough for it to be actionable or for anyone to feel better about that side of the equation. The best trade over the last 10 years, and that trend is being accelerated in this environment, the best trend over the last 10 years is to look at a very non-traditional metric. And the quants hate when I say this, but if you just weighted stocks in your portfolio based on how people are spending their time and what they're actually using and doing all day, you've made a fortune because you're in names like Apple and cloud names like Microsoft, Google, and Amazon. So that has been the trade. And then when you think about the stay-at-home version of our regular lives, look at what Azure announced look what Microsoft said about Azure. 59% growth in cloud, 59%, and they're already the biggest or the second biggest. So it's just incredible what the growth they're seeing in that business. Look what Google said on YouTube, 22% growth in subscriptions. I don't know anyone that has a subscription to YouTube, but I guess that's a thing. They made over $4 billion with it. And then 33% growth in YouTube ads. So these are trends that had been in force for a decade. They're accelerating now. So it makes it really hard to say, I want to have a portfolio that underweights these names. It's really, really hard to do that.
Yeah. So, Joe, how does it all set up then for the way we should look at Apple? I mean, you know, Apple's different than these companies. Sure, there's a services arm, and we know about that. But at the end of the day, you're trying to sell phones. And China's a big part of your business, and you rely as a consumer-facing brand on the consumer to continue to consume your product.
Yes, and I think that's all correct. And each of one of these names, they're core holdings. Absolutely. The characteristics that define them as cash-rich companies. And what is also very compelling about these companies is that they have an ability for shareholders to pay a premium for their stock price in the absence of buybacks. We're going to be living in a COVID-19 post-investment environment that's going to be void of the amount of buybacks that we experienced in previous years. So that's why they're core holdings. I will say, though, they can be tired, and they have been tired in the last 5 days. You're seeing today a Microsoft barely trading unchanged. The last 5 days, you've got Amazon basically around unchanged. That doesn't mean you're getting out of these names. I think what you're looking to do is understand that they are core holdings, and then to reference Josh's comments as it relates to the Russell and small caps, universally in the last 3 days, all I heard was everyone applauding the fact that the Russell and small caps were moving higher, and there seemed to be a clamoring towards that trade. I think a lot of us have talked about being very judicious in stepping into that trade. So I think where we are right now, Scott, the most important thing is not how much cash you maintain, but what your risk exposure is to the market. And unquestionable, with the S&P at 2950, you have more risk than you did 3 weeks ago, and you're going to have to measure, mitigate, and account for that risk and go accordingly.
So, Josh, just about everybody out here owns Amazon. So to the point of Joe making, you know, the S&P, given where it is, that adds maybe a level of risk, right? Just given the move itself. What about that for Amazon? How do we all feel about Amazon going into this number, knowing the move that it's already had? Josh, I begin with you.
Well, technically it looks great, but they always look great, right before a big move lower, because everyone's in when they look great technically. So fundamentally, is any company on earth better positioned for this moment than Amazon? Probably not. But does anyone disagree with what I just said? Is anyone not aware of that? Probably not. So could it be overcrowded? Could it be, quote, due for a pullback? Absolutely. If you've been a long-term holder in Amazon and you've stuck with it quarter after quarter after quarter, you know there's always that one quarter during the year where they stick their thumb in your eye and they throw a whole bunch of expenses in that you weren't expecting, and you get a pullback in the stock. But if you've not been in it, you should be rooting for that. Or if you're not in it in size and you want to be bigger in Amazon, that's the quarter that you wait for all year when they do that to you. But Jeff basically is operating at a scale and scope that no one else on the planet can match. He can enter new businesses at will. He can exit things that didn't work out at will. Nobody criticizes. And the company's got a great position in terms of its financial flexibility. So, yeah, you could say it's gone up a lot, but then my retort would be, obviously, look what they're doing. Sure. It should have gone up a lot.
No question. But you raised that critical point, John, is that there's no big secret, right? We all know why it's up the way it is. Now, just because it's crowded doesn't mean that it has to go down. Is the expense line going to be higher? Maybe they're good expenses. They've added human capital because their demand has been overwhelming. That's part of the story,
75,000 new jobs coming.
Mm-hmm.
Yeah,
John?
And you're both right, Josh. You and Scott, that this is one of those situations, Scott, where you'd like to buy it if you are lucky enough to get a pullback. You'd like to buy it. I don't hear anybody telling me, hey, if it pops 5%, get me out. or anything like that. They want to hold this one forever. Now, that doesn't mean they're right, because forever is an awfully long time. But I see no reason right now, Judge, with all the factors that you cited, all of which are correct, that there really is nobody better positioned for this than Amazon. Now, are they going to throw a bunch of expenses at it? Yes. Is that going to cripple the company? No. And if somebody decides to get out, they'll be wishing they were back in, 6 weeks from now or whatever. So I don't see this as one under pressure, but I don't know that it's got a lot of leap left to the upside based on everything that it's done so far.
Okay, so let's do this then, because I'm going to play off those words that you just said, John Najarian. The leap, if there's any leap left. Let's talk about the market at large, okay? Because we've been debating just about every day, Margaret Reed, whether the market, quote unquote, deserves to be where it is, right? Relative to the greater economic situation, underscored yet again today with a record number of jobless claims. I've got a couple of notes in front of me that I want to bring up and I want to debate with all of you. Tom Lee today, S&P 500, not necessarily irrational, he said. Could be sensing operating leverage, he says, of the S&P. We also believe the equity markets, along with high yield and credit broadly, may be suggesting that an earnings recovery stronger than one could logically perceive may be underway. Let's take that note first. Margaret Reed, you get the first comment on it.
Yes, absolutely some great comments there, but I would certainly argue that, one, we're in a market that has certainly reached fair value and is absolutely disjointed from what's happening on the ground economically. With the claims out today, 30 million unemployed, we are in front of some very blunt and negative economic indicators over the next month. We have companies across the board, industrial companies, consumer companies, Facebook last night, saying that Q1 was not the worst. Q2 will be even worse than what we just saw. And, the markets are not pricing in that we're going to have another significant cut to earnings in the second quarter. And, this is a market that's looking at the white swan event, as we'll call it, from Gilead's remdesivir yesterday, ignoring what is still, quote unquote, the black swan of the economic data. And at some point, the market has to return to fundamentals, return to what the earnings picture will be. But we are in a black box of that earnings picture, with 80% of the companies that have reported thus far that have suspended or pulled their guidance. So, it's a very critical juncture in the market in my mind.
Sure. And Steve Weiss, Tom Lee's not dismissive, nor is he naive of anything of what Margaret Reed just said. He says, if you ask me, does the S&P 500 recovering to 3,000 jibe with 30% unemployment, a Great Depression type number, Fed at zero rates? I would clearly answer no, he says. But here we are. Maybe we have a faster recovery, he thinks, in earnings than some people are expecting. That you could even get a faster recovery in earnings if you have a slower recovery in overall GDP. That's a provocative thought. You may consider it controversial, and you may disagree with it wholeheartedly. You tell me.
So unquestionably, the market should not be where it is, without a doubt. It's a tale of two cities right now. You've got a disastrous economy with no real signs of improvement, and you've got a market that's had just an amazing move higher. Here's where I think Tom Lee is wrong, is that he's talking in a generalization. As we see companies cut CapEx, that's going to filter through the whole economy. But yet, there are some companies that are going to do well, and they're the companies that have been doing well. So the markets, capitalism, very Darwinian. Sometimes it takes a little longer for that to play out, but we will see it. So when we talk about Microsoft and we talk about Amazon being defensive, they're like Michael Jordan. They can play great defense and great offense, and that's what they're doing. So I'd be still worried about the Caterpillars. United Rentals had a great move. I think that's way overdone. If I were to short stocks in this environment, that's one I would short, because CapEx is not coming down, particularly the leverage to energy. So you have to be very focused. There are parts that will work and deserve to be where they are, as names I just mentioned, and the others broadly shouldn't be where they are. But some will do well coming out of this.
So, Josh Brown, look, all things being equal, Steve Weiss is right. The market doesn't deserve to be where it is, although that's a loaded word. But all things aren't equal, right? Because the Federal Reserve, what the Fed has done with its unprecedented level of liquidity, has made it so all things are not equal. So let's play that word, which is controversial to use when you talk about where the market is and where it maybe should be. Deserve. The market may not deserve to be here. I don't think anybody in their right mind looks at Main Street and says the market deserves to be at 3,000 on the S&P. We're not that far away. We're 2,900 today. Yesterday, we were within 60 points of that. But all things are not equal.
So we don't get the benefit of being able to see a counterfactual in real life. We can only imagine it. And I'm going to say something that's maybe a little bit controversial, but if there were no coronavirus outbreak this year, I think the stock market would be right where it is now, which is so bizarre. But think about what we would be dealing with. We were already pushing fairly high valuations. We were already in a situation where we knew the Fed maybe would act one more time or two more times for the year, but then would probably be done. And we were ricocheting back and forth between 2 and 3% GDP quarter to quarter without much in the way of, quote, acceleration. We didn't particularly have strong commodity prices. Housing prices were somewhat tame. So we were in a good economy, not the greatest economy of all time, as we've heard from the podium, but I kind of think stock market would be right here anyway. So that shows you how much the Fed and the Treasury have thrown at this situation so quickly. The fact that we're still in the same place with this massive outbreak. One very important point I want to wrap up with, Scott. We do this with clients as an exercise all the time. If I told you in January we would have 26 million lost jobs in 5 weeks and showed you what those charts would look like on industrial output and consumer confidence, and that, you would have said, oh my God, it looks like an alien invasion took place. And if I gave you what those numbers were, you still couldn't have told me where the stock market would be. You'd probably be talking about Dow 14,000 based on me showing you that data. So that's a very important reminder of why it's so hard. Even if you get the economic numbers right, you still don't know what the government's going to do, what the Fed's going to do, and what the crowd is going to do.
Because we should have, Joe, maybe we should have learned our lesson, so to speak, the last time we had a crisis. And this one, I think you can fairly say, is bigger than the last one. It's just a little bit different. That when the Fed throws everything at it from a liquidity standpoint, you created the longest running bull market in the history of the world. And here you are with a Fed-induced V-bounce in the stock market because they've brought out even more bazookas than they used in 08 and 09. So maybe it's not that difficult to realize why we are where we are. Even Lori Calvasina of RBC, who's been more negative than positive of late, says today the rebound seems legitimate. It seems legitimate, driven more by good news than bad news in recent weeks, but it's also fragile. I think everybody feels like it's a little fragile. The magnitude of the move, she says, in the U.S. equity market so far and the composition of leadership are mostly in line with the recovery trades associated with past recessions. Is she right?
So one of the things that's been a guiding indicator for me over the last 5 to 6 weeks, and we probably should be talking about it more, and I know we will shortly with your guest, but it is the credit markets. And you talk about the liquidity, Scott, that the infinite Fed is providing. They've taken the systemic risk out of those credit markets. They've stabilized them, and you're witnessing the month of April that is historic in terms of its performance for investment grade and high yield. Investment grade is actually higher on the year. So I think the beginning of what you're witnessing in the equity market really occurred in the credit market. As it relates to the equity market,
100% right. I mean, of course, you're 100% right, but it goes all circles back to the same MO of what we've got. Right? The Fed did that.
Okay,
the Fed thawed the credit market.
The Fed. Absolutely, and that was the leading indicator. But let me finish my thought. You used the word before, all things not being equal, and I completely agree with you. But let's understand, the S&P 500, it's not an equal index. The S&P 500 is market cap weighted. And if we want things to be equal, change the construction of the S&P 500 and make it equal weighted, because the equal weighted component of the S&P 500 is significantly lagging where the S&P 500 that's market cap weighted is.
You had a conversation, John Najarian, in the last weeks that went from such and such ticker symbol may be insolvent at some point to, hey, they went to the credit markets and they raised billions of dollars in debt and they're all good now. That we don't have to worry about said ticker symbol anymore because the markets became accessible in a way that they were inaccessible just a few weeks ago.
True. And, to that point, Scott, absolutely correct. The markets did not freeze up. That was what the Fed was so aggressive with, these two big moves that they've made. Congress, of course, making several moves as well. One of the lessons learned from 2008 was don't wait as long. If you're going to hit it with that bazooka and do it now. But also to Joe's point with you, it depends on the market you're measuring because these are cap weighted. The market we're measuring is the economy all Microsoft, Google, Facebook, is it all Amazon and so forth? Is it all those stocks? Because they're the dramatic outperformers and a very small segment of America is employed by those companies. So if you want to say, well, but how are these companies doing and why is the market up versus the economy that we have 30 million of us Americans out of work, it's pretty easy to see why, because of what we're measuring it against. So it's like we've stacked the deck on the one side. We have this cap-weighted index against 30 million people out of work. Now, the Citigroup, I thought, was an interesting statement today, Scott, where they said, obviously, this can't go on forever. I agree. It can't go on forever in terms of the Fed-induced lift or the hand under the market. But hopefully the economy comes back around. That's why the Congress, that's why the Fed have thrown so much at this, so that can happen rather than just the free fall to 14,000 like Josh says, or some other level in the Dow.
Margaret, it's maybe as simple as Ed Yardeni says today when he asks, what is the market thinking? Well, the market's been cornered by policymakers, and for now, that's bullish for asset prices. Maybe it's just no more complicated than that.
I think it is more complicated than that. We've had the V-shaped recovery, obviously driven by the stimulus, which was what Lori points out. But there will not be a V-shaped recovery across the various sectors of the S&P. Think of all the areas like travel, leisure, lodging, brick and mortar retail. These are areas where the consumer is going to take a considerable amount of time to get more comfortable with those areas of their overall demand. And I think it's important to focus on the active management within those sectors and the companies you invest in. I think this environment has also redefined what quality company is. And those companies that have taken on extensive debt, maybe they've been able to reprice it. But guess what? There'll be areas of the market where their cost of debt is going up. Default rates are going to go up on the lodging sector, on the retail sector. And that means longer term implications for some of particularly the smaller companies that are being really hampered by this pandemic.
Hey, Weiss, Citi asks a question, rightly so. Can markets really be propped up indefinitely? I mean, right, that's the central sort of issue that we're discussing. Why are we here and where are we going from here? They wonder whether they can be propped up indefinitely. They say the gap between markets and data on the economy is the largest on record. That's exactly what we're talking about, right? Positioning is super defensive, they say. If, of course, you're talking about Microsoft and some of these tech names as being defensive plays, as we were discussing at the open of the show. They're right to ask that question.
Without a doubt. And I think the way you look at the Fed, and Powell is very clear, there's more to do, and they will keep doing it. It's an unlimited balance sheet. But I think here's the optimistic dialogue. I'm not saying I necessarily subscribe to this, but here's what it is. You take a look at the first quarter. We had January and February, which most companies, even the worst affected companies, said was pretty good, and a steep fall off in March. In the second quarter, we're seeing the worst of the economy in April. But now, as states open back up, as businesses go back to work, people go back to work, we can come out of this, the second quarter, going into earnings, with momentum to the upside in the economy. Now, as Margaret points out, some just aren't going to recover for a long time, if at all. But the headline dialogue, keeping in mind the backdrop that historically markets are up 85% of the time. So you've got to be an optimist to be invested. And what really pisses me off is that a lot of people are getting this, the volatility. They're buying when stocks get hit. I liked it better when everybody would puke it, and that'd give you an opportunity to go in. You're not getting those opportunities on the great names as much as you used to. So, look, I think the market's wise to some extent. I do think we're extended, which is why I sold this part of my Lulu position. I thought that was way overdone to the upside, getting close to the highs. So I think you have to be prudent. But to go risk off or risk on in this environment when the Fed is there and is going to be there is the wrong move at this point.
Well, that's maybe you need to go risk neutral, right? If you're already in, you sort of sit tight. You don't. It's hard to tell somebody to add fresh money to a stock market that we're questioning whether it deserves to be where it is. But at the same time, we're not telling, you have to be cognizant, too, of the fact that you could have positive news at any moment, i.e. remdesivir yesterday. You just never know what's going to happen regarding the virus and breakthroughs regarding therapeutics or even further along the line towards a vaccine. So let's talk more about the moves that all of you are making. Let's go even more sort of granular on things. Joe, you sold JP Morgan, you sold Wingstop, and you sold the HYG. Talk to us.
Correct. So again, at the top of the show, I talked about managing and mitigating risk. S&P 500 at 2950. I've got to look at my risk and I've got to manage that. JP Morgan, I've been trading around that. Lower 80s to the mid 80s has been a buying range for me. Mid 90s to upper 90s, that's where I want to take profits on that. I already have significant financial exposure. I'm comfortable with that. I also don't like the fact that the 10-year Treasury is falling back towards 58 basis points. We'll talk a little bit more about that later. HYG, I don't think the universal investment application towards corporate bonds is going to work at this level. I think you have to mine for specific opportunities going forward. That's why I'm out of that. And Wingstop, listen, I got lucky. This stock fell down to 44 in the peak of the March sell-off. Got up to 120 the other day on a lot of positive news surrounding its online platform. I'm just ringing the register, taking profits there, and also understanding I bought Starbucks the other day.
Sure. Margaret, this is interesting to me because you definitely sound a little more negative, if you want to use that word, cautious, to be more fair to you and your point of view, than the others do. But yet, you only have 5% cash, which you say is high for you. Talk to me. Tell me why.
Well, for our client base and my client base, we're in fully diversified portfolios meant to be fully invested. 5% cash is against, other areas that we have exposure to, whether it's the bond market or the equity market. But having some additional dry powder here, I think, makes sense at where the market stands. But I do feel that there will always be opportunity every day in this market. So, yes, the market's at fair value, but underneath the surface, look at some of the names that are trading off today, like a McDonald's. I would put McDonald's in the high quality company bucket that can sustain a dividend that is going to benefit from the eventual reopening of the economy. I think a June reopening is way too optimistic here. And it's really just combining, what is the fundamentals, again, with what the market is implying here, particularly when we have such stark outperformance in some of the more value areas of the market, like financials and energy. So yes, a little more cautious on the cyclical side of the market, but I still think there's areas to own here, particularly with, like Joe said, where the 10-year Treasury is, focusing on companies with dividend yields. So in my mind, we've been focusing more on owning utility companies that can sustain a dividend over energy, which is only 2% of the S&P. Not as critical in my mind to own at this juncture. Still have some exposure to staples, companies like a Coca-Cola or even a Constellation Brands that can benefit from the economy reopening, but also from a pretty favorable commodity environment. So I think there'll always be opportunity within the markets here. A little more cautious on the cyclical side, but certainly, I think we'll have more opportunities. We're still in the midst of earnings season here.
So, Josh, Margaret just mentioned McDonald's. So, right, the quarter was mixed. They expect, the CEO told us on this network, they expect the second quarter as a whole to be significantly worse than what we experienced for the full month of March. I think that's a reasonable view. But what's your take on McDonald's here today?
So I was looking at McDonald's and a bunch of these names, and I feel as though McDonald's is like, if you had to put it on a scale to does the good outweigh the bad versus other stocks that are consumer discretionary or food service, in terms of what their attributes are versus others, I would say McDonald's ends up being in the winner pile. They've got a lot of drive-thrus versus other chains that don't have as many. They're more international, and most of the world has gotten back to real life faster than we have. So they've got a lot of positives. I think they've been very aggressive with tech and delivery, and we know how important that's going to be going forward, no matter what kind of treatment we get for the virus. So I think McDonald's is like in the category of the names that you would rather be in than not as the economy recovers. And you should say to yourself, I accept the fact that this might be one of the worst years McDonald's ever has relative to the year prior. But that shouldn't be the reason why you're buying the stock for what they have to say about April, May, June.
I mean, the CEO just told you the second quarter is going to be horrendous. My word, right? Not his.
Great. That's what. If you're a buyer, that's better. If you're a seller, that's not so great.
Yeah, no, that's exactly my point, right? If you're looking at the stock, you have to at some point assess whether the worst of the news is in a name like that. The CEO just told you what's happening. Stock's down 2.5%.
Yeah, I'm in Starbucks. I think for a lot of the things I just pointed out about McDonald's are applicable to Starbucks. It's a recent purchase. If it falls back again because of the overall market, I'll buy more. I do think that those will be the brands that carry through. And into the end of the year, you say, wow, we stole these stocks.
You surprised at what KJ said yesterday to the gang on Squawk on the Street? Kevin Johnson, CEO. 90% of the stores reopen in June.
Was I surprised that they're that bold? No, not really. It's been a while. I think they've had a lot of time to plan for the reopening. I hope it goes smoothly. I think everyone does. They've had their drive-thrus open and their regular stores closed, but I think they've learned a lot. And I think they'll be as ready as anyone else is. Who knows how to deal with this? We really don't have a scenario like this in 100 years. So I don't think there's a modern playbook. But if you had to bet on somebody getting it right, I would bet on the companies that invest heavily in their people and in their technology. And Starbucks is like at the vanguard of that for the quick service restaurant group.
Weiss, last thought before I take a quick break. We discussed selling half of Lulu, but I don't think, and if I missed it, I apologize, you added to the XBI. I don't think you told us that yet.
Yeah, no, I did. Look, with everything that's going on in healthcare and biotech, I wanted to participate. I own some Moderna. I bought some more of that yesterday, actually, when it sold off on, I think, the Gilead news, which has nothing to do with it, but also Pfizer and their vaccine. So if I had to guess, my plan is to be a net seller over the next week, just take some profits. But my stocks are working. My portfolio is really, just all about 5G, with the exception of the names I've mentioned. And, they're doing well. They're performing fundamentally. As stocks, I can't help that, but fundamentally they're performing.
Sure. All right, we'll take a quick break. Straight ahead, Avenue Capital's Mark Lazary. He gives us our weekly check-in on the market. He's also the owner, of course, of the Milwaukee Bucks. We'll get his take on calls to cancel the rest of the NBA season when we come back. 2 minutes on the half.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
With the NHL season temporarily on ice, now is a good time to catch up on past games. With Game Replay on TuneIn, you can hear every matchup of the 2019-2020 season so far. And for a limited time, it's free for hockey fans everywhere. Search classic Game Replays to start listening.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn. How do you keep track of all your favorite stations and podcasts? Easy. You add them to your favorites list. Just find the audio you want to bookmark and tap the heart icon. Then whenever you want to browse your favorites, you'll find everything under the Favorites tab.
Keep up with everything happening in the wild world of pro wrestling with the TuneIn podcast. For expert analysis straight from the WWE to Steve Austin's no-holds-barred conversations with wrestling's biggest personalities, search sports and scroll down to the world of wrestling to listen. While you wait for baseball season to begin, TuneIn has dug into the archives and blown the dust off some of the classic games in MLB history.
There it goes, 3-2 pitches, hit in the air and hit well. Center field, Bader back at the wall. It's gone!
Search classic game replays to relive some of the great contests in America's pastime.
Ground ball out to Jackie Robinson, up with it over to Reese for one, back to Hodges. It gets away from him. Barrows trying to go to second. Hodges.
It's on demand, it's free, and it's only on TuneIn.
A social distancing tip.
Keeping your distance from others is important in slowing the spread of coronavirus. So here are some fun things to do alone. Read a book, take a walk, unpack your suitcase from that trip you took last September, paint a self-portrait, catch up on a TV series, do a puzzle. Remember, we should all stay home to lower the risk for everyone. For more info, visit coronavirus.gov.
Let's all do our part, because we're all #AloneTogether. Brought to you by the Ad Council.
Behind the highlight reels, championship rings, and colossal paychecks, there are sports stories that fuel, deepen, and even challenge our love for the game. For true tales of underdogs, anti-heroes, and game-changing innovators, explore a sports documentary on TuneIn.
It works. All right, welcome back. Show you a live picture of New York City. A bit of a gray day, as you know, some rain in the area here, but you are looking at a live shot right now of the Navy ship, the USNS Comfort. It is leaving New York Harbor, returning home to Virginia. Cameraman at work there. I told you it's a gray day, kind of messy in New York City, but that is a sight of that ship leaving. It was docked in Manhattan on March 30th, originally deployed to care for non-coronavirus patients. And by early April, it had begun accepting some patients who had the virus as hospitals in New York City began getting crowded. However, last week, Governor Andrew Cuomo said that ship was no longer needed. Pressure on the hospital system appeared to be easing. He continues to report what appear to be better numbers out of New York. But that's a live picture from New York Harbor as we speak. Sue Herrera has the other headlines for us. Hi, Sue.
I do indeed, Scott. Thank you very much. And speaking of the governor, everyone, New York's Governor Cuomo says his state is now teaming up with former New York City Mayor Bloomberg and Johns Hopkins University to train an army of contract tracers. Cuomo says New York will need between 6,000 and 17,000 people to track contacts of people who have tested positive. The nation's top spy agency says the COVID-19 virus is not man-made or genetically modified, but it is, quote, rigorously looking at whether the outbreak is the result of contact with infected animals or a Wuhan lab accident in China. The New York Times reports the top Trump administration officials are pushing spy agencies to look for evidence supporting the lab theory as President Trump blames China for the pandemic. And 1.5 billion fewer people are expected to take international flights this year. The International Civil Aviation Organization also expects seat capacity on those flights to sink 75%. As always, you can get more on our coronavirus coverage by going to CNBC.com. Scott, back to you.
All right, we appreciate that. Sue Herrera, thank you. Let's bring in Avenue Capital's Mark Lazary now for our weekly check-in on the markets. Mark, it's good to talk to you again.
Pleasure to be back.
Seems like every week we talk to you, we've taken another tick up in the market. It's astonishing, really. What do you make of it?
I don't understand it because every week all you constantly have is more bad news, where companies, like you just had sort of the CEO of McDonald's telling you how horrible things are going to be. I think the market is excited about the fact that things are going to reopen. But if you take a look at areas that have already reopened, which is out in Asia, things there are going really slow. So I think you're going to have a pretty slow, stores may be reopened, but for people to start spending money and for the consumer to be there is going to take longer. So I think for us on the credit side, anything that is being restructured, they're going to have issues. I think every other company sooner or later is going to have to come back to reality.
Yeah, you're going to be busy looking at all the opportunities that you may have. And you know, in some respects, or maybe every respect, this is right in your world. I mean, the reason the equity market is where it is because of the credit market being where it is, right? And we have definitely had a thaw since the first time we had you on discussing the market. You'd agree with that, right?
100%. Look, all of this is, this isn't based on fundamentals. And I think Josh spoke about it and you've spoken about it. It's all based on what the Fed is doing. So if the Fed continues what it's doing, I mean, the markets are going to keep going up and there's just more and more liquidity. But sooner or later, reality has to come back and people have to look at what's a company making. So whether that's 30 days from now, 60 days, 90 days, 6 months, it'll get there. It's just going to happen.
I want to talk about a segment of your business that we really haven't discussed much of late. And let's do it now, and that's aircraft leasing. You know, we just had our news update. Sue Herrera said we're looking at 1.5 billion fewer international travelers this year. Dave Calhoun, CEO of Boeing, was on yesterday talking about, he used the word thaw in terms of what he was seeing. How is your business of airline leasing, doing right now?
Well, I mean, look, that's having issues. And it's obvious just simply because planes aren't flying or they're not flying as much. So really what we're doing there is working with everybody to just give people more time to pay us back and to do what they need to do to get back to normal. So I think we've got to work with people and give them the time. And the question is it 3 months, 6 months, or a year? That I don't know. It just depends on how quickly people start flying again. But obviously that business for us and things we've invested, that's going to get hurt just because you've got to give people more time. And then on opportunity set, you're able to come in and, whether it's on financing or whether it's buying new planes, you're able to do those on anybody who's got to sell. You're able to do those at pretty big discounts.
I was wondering about that, almost more of the latter than the former, certainly thinking that part of the business would obviously be hampered given the environment that we're in. But do you also think that on the backside of this, leasing aircraft like you do to airlines will be more desirable for them rather than making a bigger ticket purchase from a Boeing?
I think in what we do, we buy planes that are 8 to 15 years old. So I think what you're finding in that market right now is people who need to sell will sell those planes at, I would tell you, probably 20 to 30% lower than where they were before. So that's the opportunity set. Everybody knows people are going to be flying again. The question is just how long is it going to take for it to get back to normal? We think it'll take about about 6 months to a year.
6 months to a year. To get back to normal or to the point where people are even just flying again?
No, where people are flying and you've got people on the planes where at least it's 50% to 75%. I think normal of being where it was a year ago, that's going to take a long time.
There's been numbers, 3 to 5 years have been thrown around. Is that in your ballpark?
I don't know, to be honest with you. I mean, I think once you've got a vaccine, people aren't going to have any issues flying. And the question is, how quickly does that come?
What's desirable to you right now in the credit market? You have, companies that have come to market. There's talk today, David Faber earlier was talking about what Boeing may do. How do you view a Boeing offering? How did you view a Delta offering? How do you think about that space in general?
I think those are all fine because I think the returns, you're coming in at a secured level. And so you'll be fine because when you look at the numbers, you know that you're going to have enough cash for the next couple of years. So I think you're fine at that level. The question is, what do you want to do on the equity side? And I think that's going to be harder.
So you bought Carnival bonds, right?
Yep.
Anything since then?
No, we've been buying quite a bit. I mean, we keep on buying, but it's really on sort of restructurings. I mean, we've been buying more on Frontier. communications, the cable company. We're buying more on Intelsat. Anything that's in a restructuring, because people don't want to be involved in that. What people want to be involved in is buying Amazon, buying Apple, buying things where they think there's little to no risk. Nobody wants to be involved in risk. So if you're involved in risk, you can actually generate some really high returns.
How do you view, retail department stores, things like that? We talked about Neiman Marcus, I think, the last time you were on, just about a week or so ago. How do you see all that shaking out?
Look, I think that you're going to have issues there. I think for us, when we're investing in that industry, where we're investing in Macy's or JCPenney, for us, we're looking at the collateral value and saying that even if things take longer, we're covered on the collateral. And so that if you had to have a liquidation, we'd be fine. So that's more how we look at it. If you don't have a liquidation, which I don't think you'll have in any of those situations, but we're investing right now at 2 to 3 times where it was pre-COVID. So today, let's assume a company, if it was making $100 million, we're investing in that company at $200 million by buying the debt.
Mm-hmm.
So where do you think EBITDA comes back? Does it come back 50%? Well, if it does, then it's 4 times where we've created the company. So for us, we're pretty comfortable where we're investing because we know that if things don't work out, we'll be able to liquidate the company at our cost, or the company will liquidate at our cost, or a little bit higher.
Oblige me for an NBA question or two before I let you run.
Absolutely.
Are we going to have a season? There seems to be now a developing conflict. Talk about reopening facilities. Maybe that has folks looking forward to a season, though there seems to be chatter on the other side suggesting we should cancel. What do you think?
I think there's a lot of unknowns, but we are, my opinion is we will end up having a season. We'll have the playoffs. But that's going to be a whiles away. And the question is that in July or is that in August? I think we've got to get back to everything being open. So I think the NBA is, a number of the facilities are going to open May 8th. I think for somebody like the Bucks, it's going to take longer just because we've got to comply with the stay at home. But that's okay. You need to get started. So I think some teams will have a little bit of an edge, but that's life.
That is interesting, though. You will have teams who have a head start in getting back to business, getting their basketball bodies and minds ready for a stretch.
Yeah, you will. But I think we need to do that. I don't think we can wait for everybody to be on at the same time frame. And, if the goal is that you want to end up having a season, let's get things opened. Let's get people getting back in shape. And then we'll figure it out come July or August, what we can do in sort of finishing the season without fans. Because what's clear is people want to see sports. You're seeing it with The Last Dance, where you're having record earnings. You saw it with the NFL draft, where you had record viewers. So I think as you have that, people want to see sports. So I think we'll end up finishing the season.
Yeah, we're starved, right? The Last Dance is awesome, but nothing beats the real thing. Mark, you take care of yourself. We'll talk to you next week.
Thank you. All right, take care. Bye-bye.
Right, that's Mark Lazary, Avenue Capital Chairman and CEO. We're going to take a quick break. We've got your questions coming up next in Ask Halftime. Still time to reach us. Go to cnbc.com/halftime. You can tweet us, Ask Halftime, with the hashtag there. And a reminder, you can always watch or listen to us live on the go on the CNBC app. We're back after this.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
While you wait for baseball season to begin, TuneIn has dug into the archives and blown the dust off some of the classic games in MLB history. Search classic game replays to relive some of the great contests in America's pastime. It's on demand, it's free, and it's only on TuneIn.
Did you know with TuneIn's local radio feature, you can stream live FM and AM stations in smooth streaming quality and discover local news, talk, and music stations you didn't even know existed. Navigate to the local radio section under Browse to listen locally on TuneIn.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
To help make the most of your time at home, TuneIn is sharing our top activities for social distancing. Tip number 4, relax. Don't feel like you have to be productive during these stressful days? This is the perfect time to focus on yourself. Whether that means meditating, taking a bath, sleeping in, or doing nothing at all, take a deep breath and treat yourself. For more indoor inspiration, search Listen from Home on TuneIn. It's TuneIn Sports on this day. On this day, 1939, Lou Gehrig sets an MLB record playing his 2,130th consecutive and final game for the New York Yankees.
For the past 2 weeks, you've been reading about a bad brag. Today, I consider myself the luckiest man on the face of the earth.
To listen to conversations breaking down the moments just like this, search sports to be part of the discussion on TuneIn.
Hey, it's Jacoby here from Jalen Jacoby, and after you watch The Last Dance on ESPN, which you're obviously going to do just like the rest of us stuck in our homes in quarantine, you can join Jalen Rose and I for Jalen Jacoby, The After Show, and we will be joined by the director of the documentary series.
All right, we're back, and we are answering your questions as promised. Margaret Reed, to you first from Bob in New York. Is Adobe a good buy right now?
I would put Adobe on my list of survive and thrive companies. Look what Microsoft said last night. 2 years of digital transformation happened in a matter of 2 months. Adobe is definitely involved in that backdrop and that secular growth, and I would hold Adobe for the long term.
Okay, Joe, to you. Joe's on the phone now, by the way. I told you it was a messy day in New York City. Hale in California. Can someone explain why Chipotle's stock price is so high?
Sure. Digital orders are up. The loyalty program continues to swell. They didn't take any government loans. They have no debt, and they have $1 billion of cash. Find me a consumer discretionary company that fits that model. That's a company that you want to buy as it pushes towards its all-time highs.
All right, enough said. Josh, to you from Bennett1279 on Twitter on Uber. Is Uber a buy?
So I bought the stock much lower than it is right now during the worst of what we saw in March. And I'm not a seller, but this has been a huge recovery for a company that, frankly, is right in the middle of some of the worst effects of coronavirus on the economy. So I wouldn't be running into this one right now. If you really want it, maybe it'll roll back over, and that might be a better opportunity.
All right, Steve Weiss coming to you. Terry in Florida. Cloudera, is it a buy after recent earnings showing strong cloud growth?
You know, I'm out of Cloudera. I've been out of it for a while. I followed Carl Icahn into it. They've actually succeeded in the turnaround. But if I didn't own so much in that space, I would take a look. But I'm not your best source on this one, although I'll tell you, do some more work because the fundamentals do look strong.
All right, Dr. J. John Najarian from Thomas in Minnesota. This is a Homer question. Your opinion on Target. How come it's only the people from Minnesota who are always asking about Target?
I don't know. You know, we'll have to dial Pete up and find out. Best Buy, Target, 3M, Medtronic, you know, all these. I'd say Target.
And on and on and on and on.
Yeah, yeah. But he's right. There's lots of great companies up there. This is one of them. What has happened and what I said about Facebook gathering more bodies, and once they're in, they don't leave. Same thing here with Target. A lot of people have signed up for the delivery judge. That'll continue to carry them forward. I like it here.
Hey, Doc, I'm going to surprise you with one more. I just got a new one. The GLD, sure. GLD or gold stocks?
I would buy the GLD rather than individual stocks at this level, Judge. I think gold does go up dramatically from here because of the Fed action.
Okay. That was from Cardi on Twitter. I just saw it. I figured throw that in the mix. Margaret, to you, Oracle. Pete in New York, longtime holder of Oracle. What's your take?
Well, we've had Oracle on our dividend strategy for some time. I view their dividend as resilient. Certainly trades an attractive valuation to the software peer group. I did like the cloud deal that they signed this week with Zoom, and that speaks to the strength of the security infrastructure of their cloud business.
Okay, Margaret. Joe, to you, Michael in South Carolina. What's your outlook on the CME?
I like the CME. I like ICE also, but keep in mind they have futures on their exchanges. I think NASDAQ is probably the better of the three. And the ultimate one is my final trade yesterday, which is Market Access, NKTX. That's a $17 billion market cap. It's up 20%, I think, for the year. 16% revenue growth over the last 8 quarters. I think the revenue was up 35% in the last quarter alone. So NKTX is the best exchange trade.
All right, I got you. Do you want to do that now, Prashant? All right, we have breaking news from Eamon Javers, who's down at the White House for us. Eamon? Or he's down in D.C. Eamon?
Yeah, that's right, Scott. I just spoke to Larry Kudlow, who's got an important denial here of a piece of that Washington Post story that just broke within the past hour or so. The piece of the story that Kudlow is denying is this report in the Washington Post that some administration officials are discussing the idea of possibly canceling a piece of U.S. debt to China. Larry Kudlow says that is untrue. His full on-the-record statement is, this is absolutely and unequivocally untrue. The full faith and credit of our U.S. debt obligations is sacrosanct, and so is our commitment to maintaining the U.S. currency as the world's reserve currency. So Larry Kudlow saying on the record, the administration is simply not considering in any way limiting or canceling U.S. debt obligations to China. Now, separately, is there an overall effort here to punish the Chinese for what the administration sees as their role in the coronavirus spread? Yes. Kudlow has said in the past that the administration does want the Chinese government to pay in some way. What he's saying here now, though, Scott, and very importantly, is that they're not considering canceling U.S. debt as part of that, despite what some administration officials may have told the Washington Post today. Back over to you.
Eamon, we appreciate that very much. We'll continue to follow that story, I'm sure, for the remainder of the day. Let's hit a few more stocks before we go. Josh Brown, someone asked on Twitter, how come I didn't ask you about Twitter earnings? Good point. So I am right now.
I love the gang at Twitter, but I said when I sold the stock a while ago, I really don't understand this company. Today was particularly baffling, considering people basically do nothing other than eat 6 meals a day and tweet. So I don't understand how ad revenue is not strong. And then when you look at it versus Snap and Facebook, it's even more bewildering. Again, I love Twitter. I love the service. I'm happy to not be an investor right now because I really don't think they figured out ads yet.
While I have you, give me your thought on Verizon. Stan in Chesterfield, Missouri wants to know.
I'm long the stock. I'm a forever investor here, regardless of price. My dividends are being paid to me in a tax-deferred account, so I am reinvesting dividends. I continue to own more up or down. I also spend probably $800 a month with them, so I look at it like I'm paying myself.
All right, let's go around. We have a minute left. We'll do final trades from everybody. Margaret Reed, it's good to see you. Stay well. We'll see you again soon. Give us a final trade, please.
I'll go with Williams, WMB, and energy. If you have to have some energy exposure, I like natural gas here with Williams.
John Najarian.
FireEye, Judge. Unusual activity, May 11 calls. I bought them today.
Okay. Joe Terranova.
Risk matters tremendously at this level. Abbott Labs fits a nice risk model.
ABT. Steve Weiss.
I'm just not putting any new money into the market at this level. Sitting on my hands. Toughest thing to do.
All right. Josh Brown, you can finish us off here.
Starbucks, Scott. Cake pops for the win.
Cake pops all the way around. All right, guys, you all be well. It's good seeing you. We'll see you again tomorrow. Let's get a quick check on the market too as we head out here. We are lower today. McDonald's is weighing on the Dow. S&P is off by 34, down 1%. We'll hand it off to Kelly on the exchange right now.
Thank you, Scott, and welcome, everybody. With stocks falling on this final day of April amid a flurry of mixed earnings and weak economic data, it's been a strong month for stocks, though. The Dow and S&P having their best month since 1987. The S&P is up about 12% right now. The Nasdaq's up nearly 15% for its best month since 2000. Let's check on the markets. As Scott just mentioned, we're seeing these red arrows with the Dow down 330 points, 1.3%, but the Nasdaq's only down 55 points. Keep an eye on that one with Apple and Amazon on tap to report earnings after the bell. It's only trading lower by 0.2%. It's also been a historic month for oil. We've been covering it every day here. We began the month at $20 a barrel, went all the way down memorably on that Monday to minus 37. And voila, we're back to almost $20 now, up 16% today, $17.50 for WTI crude. These extreme moves show just how severe the demand loss has been and the storage glut for the oil pit. But let's get to all of the action that is driving the markets today. And as always, we turn to Bob Bassani for that. Bob?
And we are great month here. S&P is up 12%. We are just off the lows for the day. We started moving up about 15 or 20 minutes ago off of the lows. look at the S&P 500 here, and you can see not a bad day. Considering the last few days, we've had tremendous gains. This is the last day of the month. You get some pension rebalancing. Just sell some stocks here because of the big moves up that we had in the market overall. So not surprising we're having a weak day. Lagarde did not sound terribly optimistic over in Europe, too, by the way, and that European market was down as well. As for what's going on for the month, all of the laggards have become leaders, and all the leaders were laggards. So everything flipped in the middle of the month, and that's because the reopening story came to dominate. So at the start of the middle of the month, energy and retail and banks were all getting killed, and they've completely flipped around in the last 2 weeks. They're the leadership group now. In the middle of the month, consumer staples and utilities were the big leadership groups, and now they're the laggards. So the market has flipped around, and Kelly, I think that's a very good sign. And the last few days, by the way, we've seen tremendous amount of expansion of the rally. The number, the breadth of the market, 3-to-1, 4-to-1, 5-to-1, or better, advancing to declining stocks in the last several days. Not today, but last several days. Back to you.
No, you've been all over that, Bob. We appreciate it. I'm curious, as we reach the halfway point of earnings right now, what are the takeaways so far?
Well, this is the weirdest, most confusing earnings season, and I've been doing this 23 years as the stocks correspondent, that I've ever seen, and it's hard to make any sense out of the whole thing. It's just really confusing. But there's three main points that I would make about what we see here. Number one, there's just a lot of contradictions. Some people are reporting great sales early on and then slowing down. Others are reporting terrible in the early part of the quarter and then picking up. It's hard to figure out. Most have been withdrawing their full-year guidance. The majority of companies report have declined to provide any kind of full-year guidance. That's creating all sorts of problems. And I don't think it's too aggressive to say analysts are really clueless. There is a ridiculously wide dispersion on the estimates because a lot of analysts are lazy. They have not updated their estimates from the middle of March. And so the estimates are really, really wide at this point. So instead of earnings guidance, Kelly, we're getting sort of green shoot comments that's helping the market. So Google talked about a difficult quarter. The consumers were shopping less, but they're optimistic that the ad revenues were improving in the last few weeks. Cummins, for example, they came out, they talked about business ramping up slowly in April, and finally Facebook also talked about signs of stability in the ad market. So usually we get guidance and numbers. We don't have any of that now. We just have some commentary. Back to you.
Yes, and we'll go off that as much as we can. Bob, thanks so much. Bob Bassani. Meanwhile, the Fed announcing today that it's expanding its Main Street lending program to include more businesses and new types of loans. But are the Treasury and the Fed taking enough risk to help the economy, and are we seeing signs that they may not be on the same page? Let's bring in Steve Leisman. Steve, we've learned a lot today.
We have. Yesterday, though, Kelly, I got to ask the Treasury Secretary, Steve Mnuchin, and the Fed Chair essentially the same question. Are they taking enough risk to help the economy, especially getting money out to those small businesses and businesses that can't get money from PPP or get money in some of the other lending facilities? Here's what the Treasury Secretary said.
There are people who have said, I should price this so that, we lose all of our money so that we support these markets. The $450 billion are not grants. So they are money that I invest in these facilities to create credit support. So I think it's pretty clear if Congress wanted me to lose all the money, that money would have been designed as subsidies and grants as opposed to credit support.
Now, the Treasury Secretary said he's not investing money like a pension fund or a private equity fund. Under some scenarios, the Treasury could lose money, some it could make money, and others it could break even. Now, I asked a similar question of Fed Chair Jay Powell at the press conference yesterday.
We can do what we can do, and we will do it to the absolute limit of those powers. We'll keep at it. And I just want people to know that we will be at it with the legal authorities that we have until we get through this thing. We will keep using our authorities. But there are authorities that we don't have, and there may be a need for those authorities to be used as well as ours.
So are they taking enough risk? Here's two programs compared. Both use $75 billion of equity from the Treasury. The investment-grade corporate bond program, that's leveraged 10-to-1, so it's 750. But the Main Street lending facility, even after being expanded today, that's leveraged only 8-to-1, and that's worth only $600 billion. And Fed Chair Jay Powell said yesterday, hey, if you can't pay this loan back, maybe this is not the facility for you. They did expand it today. Treasury Secretary Mnuchin has more money, Kelly, that he can maybe add to it. But right now the debate is, are they taking enough risk with huge consequences here for the outcome for the economy?
So, Steve, you know, at a time when people are looking for this as the next big program to open, I just assumed, I mean, one of the hallmarks of Jay Powell being at the Fed, ironically, in this twist of history, is that he's a good friend of the Treasury secretaries at a time when they need to coordinate very closely. Is there a bigger rift there than we might have expected?
I don't know. My reporting does not reveal necessarily a rift. Maybe some differences of opinion, maybe some questions about how all of this will be judged with the outcome. Remember Hank Paulson with the TARP, along with Timothy Geithner, the Treasury secretaries, they were able to get a profit from the TARP. Now, is that the measure you should be looking for? You could argue, Kelly, that the Treasury secretary did his job if the Treasury loses all the money, not through fraud, but through trying his darndest to get as much money out as he could. Other people politically may judge the Treasury secretary this way, that, hey, he got his money back. And that's really the nut of the question as to whether or not there's some business owner out there that is or is not going to get a loan based on the risk that the Treasury Secretary decides to take with the taxpayers' money.
And now, of course, Treasury has to figure out whether to look in, you know, this whole extinguishing China's debt. I imagine we haven't heard from them on that yet. I know that Larry Kudlow just denied it, but that's going to certainly...
No.
Yeah.
Right.
Well, all right. We'll leave it there for now. Steve, thank you, sir. Good to see you. We appreciate it. Steve Leisman for us.
Thanks.
These unprecedented measures that the Fed and Treasury have taken have given the bulls some life this month. The question now is, will this showering of trillions in April bring economic and investing flowers in May? Joining me now are Jack McIntyre, the Global Fixed Income Portfolio Manager at Brandywine, and Margie Patel, Senior Portfolio Manager at Wells Fargo Asset Management. Jack, I'll just start with you. So, in a nutshell, is the stock market telling us that we're about to get better economic news, even though we're in the middle of a deluge of bad news right now?
Yeah, you're right. I mean, obviously the market's forward looking. I think it's interesting because I actually think there's probably a little too much greed in the equity market now, but you've got still fear in the real economy. And it's going to be interesting to see how that plays out. Certainly equities are telling you that we are going to start to see an uptick in economic activity, but you know, that's going to be yet to be determined, the time frame of that and what degree we're going to see the uptick in the real economy.
Right. So what is your base case right now? I mean, what do you think the market's pricing in?
Oh, I think the market's probably pricing in some version, maybe not a V, but a U coming out of this. And I think it's probably a little too aggressive in that. My view is that, hey, clearly we're going to get some type of uptick in economic activity, given that the economy basically stopped. But, you know, it's not going to be a V. It's going to be, you know, we throw out sort of a reverse J or something to the effect. You'll get a recovery, but then we're going to have to kind of sort of more gradual uptick.
Yeah, but Margie, it's interesting that everybody seems to have the same point of view, which is, you know, I was just pointed out the consensus thinks the stock market is ahead of itself and the economy won't be as strong. You know, what if that consensus is wrong? What if the stock market is right?
Well, I think the stock market right here is really driven by short-term, a lot of trading-oriented money back and forth, a lot of big swings up and down, rather than the fundamental direction. And I think that really what we're going to see over the next few months is a market that goes up and down a lot and doesn't really make any big advances or go down. When I look at what the Fed has done is just provide a liquidity bridge from when the bottom fell out of most businesses, giving them the liquidity to operate until we come out on the other side of the coronavirus and we start to see the business community healing. And then we'll be in a position to look for higher earnings. But that's several quarters away at this point.
Margie, that said, you guys are buying some of these junk bonds here that you think offer, you know, appreciation and you know, yields and are attractive right now. This, as the Fed, of course, has said that it will step in and support those aspects of the market without having launched anything major just yet.
Yeah, well, I don't think you need anyone to really come into the high-yield market. If you look at, say, the top quarter, the top third of the high-yield market, those companies are in good shape. They have the liquidity to operate, either positive cash flow or money on the books to operate until their earnings improve, and will be not bankruptcy risks at all because they have fundamental good businesses. And those, I think, are pretty attractive because you can get a yield of 6%. A lot of those bonds are trading at 90 cents on the dollar. So over the next 12 months, you could be looking at approaching double-digit rates of return. That might be pretty attractive and pretty high competition against an equity market that is still sloshing around, not going anywhere.
And I guess implied in that is an economic recovery. Margie, can you give any names or names that you wouldn't recommend junk bonds in?
Well, I think rather than specific names, I'd say that the weak sectors are still to be avoided. They aren't bargains, even at these very low prices. So we're avoiding retailing, gaming, travel, anything in the energy space. We think the risk is much too high, so we're not looking at that. We're looking at industrials in the healthcare space, utility space, things like that, where they're going concerns.
Sure. Jack, I know you didn't look like you liked my consensus comment, so I'll come back to you to respond.
Yeah, because look at the bond market. Treasuries. I mean, treasuries. Hey, in a world if it was truly healing, which equity markets are pricing that in, I think treasury yields would be higher, and they're not. And I know the Fed's buying them; they've cut back, but I think the bond market is a more powerful signal than what equities are telling us.
All right, Jack McIntyre and Margie Patel, thank you both talking markets with us today. Shares of Macy's, you just heard Margie say she's avoiding the debt of junk-rated retailers. Shares of Macy's are down off their lows about 5% right now. We just learned they're working on issuing debt to raise cash and plan to have all the stores reopened in about 6 weeks. CEO Jeff Gannett giving an update just a short while ago, then immediately hopped on the phone with our Courtney Reagan. Courtney does join me now with more of his comments. Courtney?
Hi there, Kelly. Yes, so Macy's is planning to open 68 stores on May 4th, another 50 by May 11th, and then in 6 to 8 weeks hopes to have the entire fleet of Macy's, Bloomingdale's, and Bluemercury stores open. When I spoke with Jeff Gannett on the phone, I asked him point blank, will Macy's survive this? And he said, yes, I firmly believe that. We have formats from off-price to luxury, a gamut of price points at a national level. I'm a 36-year veteran of this company, but I retain this optimism for our role in American retail. April online sales for Macy's were better than expected. Beauty, activewear, and home, including furniture, among the strongest categories. Gannett did say that Macy's is working on secured financing, possibly backed by inventory or its unencumbered real estate. In the webcast with Gordon Haskett Research, CFO Paula Price said its quick actions have kept cash burns to, quote, not much at all. She didn't quantify the level, but said it was below Gordon Haskett's $40 million weekly estimate on average. Now, Gannett did also tell him Macy's will emerge all of this as a smaller company. That could mean more store closures, certainly a smaller sales base, and also a smaller workforce. He says the last thing I want to do is unfurlough workers, bring them back, and then ultimately have to lay them off when we see how things plan out. Kelly?
Courtney, so I'm curious what support they and others might receive from this expanded Main Street facility. I know the National Retail Federation is very pleased with the details. They think more retailers will be able to benefit it by raising the employee cap to $15,000, $6 billion in revenue. Maybe a company like Macy's could be a beneficiary. What did he say about government support?
Yeah, so I asked Gannett directly, do you think the government should do more to help retailers like you in your position with thousands of employees, more than 100,000 employees, but that is also considered a fallen angel when you're looking at the debt standards? And he said, look, we've been actively involved with the lobby groups, was on the phone with Secretary Mnuchin. And Secretary Mnuchin, he said, we'll have more clarity in a couple weeks about that $450 billion program. And Macy's might eventually benefit from one of these government programs. But Gannett said, look, I can't count on that. Right now, I'm going to the private market, and we are in the process of securing that financing.
Yep. Courtney, thanks. We appreciate it. Great reporting. And again, the Macy's shares down about 5% now off the lows of the session. Coming up, they've doled out $1 billion in PPP loan commitments to clients, including Junior's Cheesecake. We're going to talk to the CEO of Stifel about what his clients are doing, how the industry is changing, and their role in the PPP program. Plus, as goes Apple, so goes the market. It's no exaggeration. We'll show you why not as the company gets set to report after the bell today. Stay with us.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn. With millions of podcasts dropping new episodes all the time, how do you keep up with all of your favorites? TuneIn makes it easy. Simply head to the home screen and find the Your New Episode section to see the latest additions.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
It's TuneIn Sports on this day. On this day, 1939, Lou Gehrig sets an MLB record playing his 2,130th consecutive and final game for the New York Yankees.
For the past 2 weeks, you've been reading about a bad brag. Today, I consider myself the luckiest man on the face of the earth.
To listen to conversations breaking down the moments just like this, search sports to be part of the discussion on TuneIn. Want to relive the glory of college football?
Balls over a man, into the end zone.
Come explore TuneIn's classic game replay collection to hear ESPN's complete coverage of the 2019 New Year's 6 bowl games. Don't miss your chance to re-experience the Rose Bowl, the 2020 National Championship, featuring Clemson and LSU.
There are going to be 2 champions on the field tomorrow night. There's going to be 1 team hold up the trophy.
Search classic game replays to listen for free.
Brian Windhorst and the Hoop Collective Podcast.
What about Giannis Antetokounmpo? He is going to be eligible to sign a Supermax extension, which we were projecting to be worth $240 million this summer. Well, if the salary cap drops, and even if he's wonderfully happy in Milwaukee, it may make no sense for him to sign when he can just wait a year and wait for the revenues to recover and then lock in.
Subscribe to Brian Windhorst and the Hoop Collective.
Search the Hoop Collective to listen.
America, your children have an amazing superpower. That's right. They can help save lives by simply washing their hands. Just 20 seconds of thorough hand washing after they've coughed or sneezed or been outside can help fight against the dastardly
Berry.com.
Welcome back to the exchange. Shares of Stifel are off their lows, down about 6.5% today. They beat on revenue, but reported an earnings miss this morning. The company, in fact, is seeing record revenue in wealth management right now. Stifel also has distributed about $1 billion of PPP loan commitments. All this amid a pandemic, which has dramatically reshaped how the company works. 90% of employees are now working remote, and the firm has expanded from 8 primary trading desks to nearly 200 separate locations. For more on what the future of finance could look like post-coronavirus, let's welcome in Stifel Chair and CEO Ron Kruszewski. Ron, it's great to have you. Welcome.
How are you, Kelly?
Well, pretty good, all things considered. Let me start with the most controversial thing here. It's the PPP program. You guys probably caught that you were name-checked by Junior's Cheesecake when he was, explaining to us why he took the money but doesn't plan on paying workers just yet, in this whole big thing a few weeks back. Anyway, he was very grateful that he was able to quickly get the money at that point. What has the process been like for Stifel, and how does it either fit or not fit most of the conversation about how this program is going?
Well, look, the PPP program was intended to get money into the economy and get money into the hands like Junior's Cheesecake. I mean, there was some, confusion about when he was going to use it. But look, their stores are closed, and that was very important to do that. So I think the PPP program has, been effective. There are cases where, people got the money that really don't need it. And I think that you've all done a good job of reporting on this, and I think that'll come to forgiveness. So my message on PPP is if you took it and you didn't really need it, don't ask for forgiveness.
Oh, interesting. So in other words, just pay the money back, which is the other piece of the program. What is the guidance for your employees when it comes to people who are asking for them? What is the underwriting process like? Are you worried that Stifel yourself is going to end up on the hook for any of this money? I mean, talk through those considerations.
Well, no, I think, first of all, we worked in a joint venture with someone. But regardless, we followed the guidelines. The borrowers, it was on the borrowers to basically certify that they needed it, and it was up to the banks to process that. So I don't feel that that's the case. Again, I think that the issue here isn't going to be whether or not someone got a 1% loan. The issue is going to be who actually got it forgiven. So I'll stay with that, and I hope that we come up with some rules and some guidelines to make sure that people that really need it are also the ones that are getting it forgiven.
Yeah, and we're also seeing the Fed obviously coming out with some kind of innovative, different ideas as it prepares to roll out the Main Street funds. I want to move on and ask you about something just of personal interest, which is what is the future of the workplace going to look like? I mean, there's huge societal implications to this beyond just how close you're sitting to your neighbor and whether, the cubicle landscape of Dilbert is making a comeback. I mean, we had the CEO of Barclays say just yesterday he doesn't think there's ever going to be 7,000 people in a building again. What does that mean for commercial real estate, for architecture, for construction workers? Is there actually going to be a CapEx boom as companies have to reshape their workplaces?
Oh, certainly there's going to be some changes. I still think that we have to get back, and I want to come back to this, but we have to come back to what were the actual numbers on this pandemic. Because you can make the argument that there won't be, buildings anymore. But look at New York. I mean, New York was literally built on the subway system, literally. If New York can't move the number of people in mass transit, then are we going to have New Yorks anymore? You can take that down to buildings and to offices and everywhere else. So I'm not ready to write off buildings as yet. We're working 90% remotely, and it works now. But I will tell you, there's a lot of esprit de corps, a lot of culture, and a lot of creativity that comes when people are together.
Absolutely. So I take your point that we shouldn't assume that, 5 or 10 years out, we're still going to be making decisions based on coronavirus. But in the meantime, you guys have to decide, even in terms of liability, right? What are those works? When are people coming back to work? What does that workplace look like? What are your thoughts there?
Well, there's huge challenges. Again, we want to keep our people safe. At some point, people are going to come back to work, and there are going to have to be protocols, and there's going to have to be understandings, not only the coronavirus, but maybe the next pandemic, whatever it is. But let me pivot for a second, Kelly, because I hear all these things about everything being done on the back end. What is the Fed doing on the back end? What about all these controls on the back end that we're doing to support the economy? I live in St. Louis, and I want people to start focusing on this, and that is the big headline in St. Louis this week was that our third largest healthcare system furloughed 2,000 employees.
Yeah.
And I don't hear anyone really talking about the fact that one of the businesses that are being the most impacted here, and the businesses that are frankly going bankrupt, are our hospitals.
Yes, absolutely.
And I'm willing to bet, I'm also willing to bet that you're going to be reading across the country healthcare workers being let go, while on the other hand, we're talking about not getting back together because we don't want to overwhelm our healthcare system.
Mm-hmm. So you're saying, in other words, the emphasis right now on, hey, Ron, what's the future of the city going to look like, is ignoring the fact that these hospitals are going under right now. What do you think should be done to, in order to support that? We've seen these hang-ups in Congress over whether to distribute more hospital relief funds through these relief packages. Is that the best means forward?
Well, no, the best move forward is to get some testing, to let it get back into the private sector so that the people that need, that you said the department stores or the restaurants can do what they need to do to get the consumer back. It isn't about what the government's going to do. That's really not going to matter. If you say I can go to a restaurant tonight, that doesn't mean I'm going to go. Mm-hmm. It means I will go when I'm comfortable. And we have to be finding ways to get people comfortable to come back to work, people are comfortable to go to restaurants. Frankly, and this is the most important, we got to get people to be comfortable to go to their own hospital, which they're not going to right now. And that is the issue, is that we've created a scenario where there's sharks in the water and everyone's afraid, and we need to bring that back as we get more information. I'm not trying to downplay this,
right,
but we better be looking at the real issue.
So you're going full Elon Musk here, or just a partial?
I'm not. I believe. I believe that the economy. If you tell me that we're going to have restaurants be at 25% capacity for the next year, my prediction is that every restaurant will go broke.
Absolutely.
You can't do that. So this is an issue on the front end about how we get people comfortable. We need to restart the economy. We need to keep people safe. But we cannot be continually looking at what the Fed's going to do to prop up an economy. That is not the long-term answer.
Fair enough. And Ron, come back anytime. We'll talk more about what that path forward will look like. We appreciate it today. Thank you, sir.
Thank you.
Ron Kashesky is the CEO of St. Louis-based Stifel Financial. Coming up, two big reports after the bell today, Apple and Amazon. Can Amazon top expectations after its shares have run up so much? And will Apple sound more optimistic than in the past? We'll discuss that. Plus, 30 million people have now filed for unemployment in the past 6 weeks, and now states are quickly burning through their funds. We're going to look at what they're doing next. And remember, you can always watch or listen to us live on the go on the CNBC app. We're back in 2 minutes.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn. Get the latest breaking news alerts and listening suggestions for new stations and podcasts. Let TuneIn keep you in the loop with push notifications. Just go to your device's settings and allow push notifications from TuneIn to get live alerts and recommendations on the audio you want to know about.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
Brian Windhorst and the Hoop Collective Podcast.
What about Giannis Antetokounmpo? He is going to be eligible to sign a supermax extension, which we were projecting to be worth $240 million this summer. Well, if the salary cap drops, and even if he's wonderfully happy in Milwaukee, it may make no sense for him to sign when he can just wait a year and wait for the revenues to recover and then lock in.
Subscribe to Brian Windhorst and the Hoop Collective.
Search the Hoop Collective to listen.
With the NHL season temporarily on ice, now is a good time to catch up on past games.
Bergeron, he scores!
With game replay on TuneIn, you can listen to every power play, slap shot, and goal of the 2019-2020 season so far.
Suter to Cunningham to Fiala, he scores!
And for a limited time, it's free for hockey fans everywhere. Search classic game replays to start listening.
Want to relive the glory of college football?
Balls over a man, into the end zone,
Come explore TuneIn's classic game replay collection to hear ESPN's complete coverage of the 2019 New Year's 6 bowl games. Don't miss your chance to re-experience the road.
Welcome back now to the very latest in the coronavirus pandemic. Over to Sue Herrera for the headlines. Sue?
Thank you very much, Kelly. Good afternoon, everyone. Here's what we know at this hour. UK Prime Minister Boris Johnson says his country is past the peak of the coronavirus cases and on a downward slope. He will announce a plan next week to ease lockdowns. New York City's subways will shut down for 4 hours overnight so the cars can be disinfected. A growing homeless population has been crowding the trains. The USNS Comfort is leaving New York City today, 1 month after it arrived to help relieve hospitals. The 1,000-bed ship treated about 180 people and discharged its last patient on Sunday. It was great to have them here. As always, for more coronavirus coverage, head to CNBC.com. Kelly, back to you.
All right, Sue, thank you so much. Sue Herrera. 30 million people are suddenly out of work and on unemployment, but states have been quickly burning through their unemployment reserves. And now they're turning to the federal government for a lifeline. Rahel Solomon joins me now with the latest on those efforts. Rahel?
Hi, Kelly. From New York to California, states are quickly realizing that they're running out of money. In fact, California now becoming the first to tap into the Federal Unemployment Trust Fund, requesting $348 million, although federal data shows that they could request up to $2 billion. New York officials saying there that they've requested a $4 billion loan. Massachusetts, $900 million in May, $300 million in June. Illinois, $1.2 billion. Connecticut, $180 million. So again, California now becoming the first to withdraw those funds. Wayne Roman at the Urban Institute telling me that he expects that Ohio, Massachusetts, and New York will also withdraw before July 1st. Although Michelle Evermore of the National Employment Law Project tells me, Kelly, that no matter how positioned a state was prior to coronavirus, they will all likely need to tap into these funds because the demand is just so great.
Yeah, and we're seeing it grow by the week. In fact, Rahel, thanks, Rahel Solomon. Now, as the pandemic grips some of the nation's largest cities, some residents have had enough and are already leaving for good. Diana Olick joins me now with the story of one New Yorker's very difficult choice. Diana?
Yeah, Kelly, Lindsay Marvel moved to New York because, in her words, you go big or go home. Well,
she's going home to Tulsa, Oklahoma. She had turned down a program last year called Tulsa Remote that pays professionals to relocate there. Last week, she changed her mind.
It has so much to offer. And so I decided not to do it. And then, of course, COVID-19 happened, Brooklyn, and it became a really scary place to be. I found that, my rent was still the same. And, what am I paying for? Everything is closed. I mean, I was living in complete fear. And I'm realizing that even more so now that I'm away. As I was driving away from the city, I just felt this overwhelming relief. I mean, I was just so tense and scared. I mean, my neighbor died who was always, telling my dog hi. I mean, friends were seeing body bags from their windows, and you're just in this survival mode. And I just was terrified.
Now, interestingly, Tulsa Remote says applications for their program have doubled in the last month. If you want to hear more from Lindsay, it's up on CNBC.com. Back to you, Kelly.
We've seen it play out, Diana, in my neighborhood. The neighbors put their house for sale just before the shutdowns hit, had only one offer and not as much interest as they had expected. Just in the last 2 weeks, even with virtual open houses and people barely able to get a walkthrough, the offers are pouring in. They have cash buyers from nearby cities like Hoboken and New York, and I've been very surprised at how quickly that's turned.
Yeah, people just want to get out. They're afraid, and mostly they just don't know when it's going to end. And when you're paying super high rent for a New York City that is not open, you start to think about leaving.
Yeah, it's true. Diana, thanks. Diana Olick in Washington for us today. Coming up, a bold move from the Small Business Administration has the lending community up in arms. We've got the details ahead. And shares of Tesla are jumping after posting an unexpected profit and better than expected revenue. But they can't hold on to their gains. They've just turned negative about 1%. And it was the earnings call, in particular, as always, that's getting buzz. CEO Elon Musk shared his strong view on the forced shutdowns that are causing all this uncertainty.
The extension of the shelter-in-place or frankly, I would call it forcibly imprisoning people in their homes against all their constitutional rights. That's my opinion. And breaking people's freedoms in ways that are horrible and wrong, and not why people came to America or built this country. What the excuse me. People, it's outrage. It's an outrage.
With the NHL season temporarily on ice, now is a good time to catch up on past games. With Game Replay on TuneIn, you can hear every matchup of the 2019-2020 season so far. And for a limited time, it's free for hockey fans everywhere. Search classic Game Replays to start listening.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn. Whenever you're unsure of what to play next, head to the homepage and discover something new. There you'll see custom recommendations based on your listening habits, along with new episodes of shows you've enjoyed in the past. Uncover your next audio obsession on the home.